Well, officially, I'd like to go ahead and welcome everybody and say good morning and good afternoon to all of you around the world. I see we've got more than a couple of people joining us from overseas in Europe and then in Asia. So, thank you very much. For anybody, Todd, I can hear your microphone actually open. If you can probably mute that for a few minutes, that'd be great. And if we do, for some reason, go ahead and turn on somebody's microphone, if we could just make sure that they don't have any extra background noise, preferably if they're on a headset. If we do, for some reason, put somebody on a microphone, that'd be great. And the other thing I'd like to go ahead and do is, say we kind of got a little bit of a structure and a format in the first part here based on all the questions you had asked us to make sure we get out there. And then we're going to have an additional follow-up open and answer, open Q&A section where you have new questions or important questions that you'd like to get answered out of today's session. So with that said, I'm going to go ahead and just go through a couple things on some PowerPoints real quick, and then we'll go ahead and move into the open Q&A. The first thing I like to do is go ahead and remind everybody, as I do in all of these webinars, it's very important. I take it very seriously. As you know, there's not a bunch of hype and fluff on my website. It's about making millions of dollars. Some of you have been doing very well and learning quite a bit and going ahead and stopped losing money. Some of you have turned profitable. Some of you are making more money than you were. Individuals' results obviously are going to vary. You need to go ahead and make sure you talk to a financial representative before you do trading of any sort, whether it's equities, futures, options, currencies, etc. It is very risky, and I don't think some people highlight that enough. I certainly do highlight it, and you notice I keep the hype off my websites and that. Because it is so uniquely individual. I've taught a lot of people over time, and it's amazing to see people do very well and other people do very poorly with the concepts you just got done teaching them. So you want to make sure, that's why I try to sometimes give those very thorough answers that Todd was alluding to earlier, because I try to make sure you guys understand things as much as possible. But understand, regardless, it is risky, and you should always consult a financial representative when you're dealing with your monies. Also, as you know, I've gone ahead and made each one of these webinars available to you guys afterwards for absolutely free to heighten your learning experience. I think that's very important, since I'm really trying to teach you here, not just give you an introductory webinar or introductory concept to make you have to come, keep coming back for class number 3, 4, 5, and 6. Each of the concepts you learn here, I want you to really learn. So I've given you the videos. The only thing I ask that you do, please, is keep them to yourselves and not share them out there on the internet and so on and so forth. So appreciate you doing that for me. Today we're going to kind of review the initial questions that you selected that Todd opened up with, and then we're going to go ahead and move into more of an open Q&A for those additional burning questions that you have. We're probably going to have to take a few more pauses than usual. As you know, the last 2 webinars, I think we've taken one quick pause in the 3.5 hour sessions that we did. But unfortunately, with my voice as it is, I may have to take a couple more today. So, but needless to say, obviously, we're going to be spending a lot of time together regardless. So, looking forward to that. Again, if you have burning questions, make sure you get those out to Todd. And Todd will be the primary person answering questions. Fletch will be there as well. But, I just want to make sure we get those questions answered for you today. And as always, this isn't a contest. This isn't I'm right, you're wrong. You're asking for my opinions on how I do things or my thought processes. And so, I'm here to share that with you. So with that said, what I'm going to do is turn this over to my charts. And give me just a moment, everybody. Okay. Everybody should go ahead and be seeing my charts. I just want to have that up there because at this point, I'm only going to be looking at my chart screen and focusing on the questions that Todd gives me based on your feedback. So with that said, Todd, let you unmute there and start asking questions.
Okay. Well, again, welcome everyone. So what we're going to do is, to reiterate, we're going to start with the indicators, moving average, support levels, Fibonacci, those types of things first. And we do have maybe 10 of those 21 questions that people want to the answer. So I think that's a fair number, and that's actually good. So we can probably flow right through these and then get to the open forum for this section, and take a little break for Robert to learn Russ's voice, and then we'll come back and then start up with the setups, entries, exits, and continue on that way. So Robert, our first question is the second one here. It's or actually the first one was how to know. Excuse me. Again, these questions were taken right off email, so the English might not be proper because we all type really fast. But how do you know how many weekly levels we can realistically expect to attain if we do not, or excuse me, if we do have a breakout on each particular day? So let me read that one more time. How do you know how many weekly levels we can realistically expect to attain if we do have a breakout on each particular day?
How many of the weekly levels, and I assume what they're referring to is and if the person's in the room, they can perhaps add clarification to that question. What we're looking at is how far could the market move based on the different levels that are at hand. And what I would do is, let me point to the various pivot points, because this will help be a guide. The thing is that, if you remember with pivot points here, and as you recall, the blue ones are my daily pivots. The majority of the time, most days, so this is my primary pivot. This is resistance level 1, and this is resistance level 2. This is support level 1, support level 2. You know, these blue pivots are all on a daily basis. If you recall, the majority of the time, the market stays within the resistance level 2 band. In fact, here we'll go ahead and we'll look. Let's just do that real quick if we may. This is the primary pivot from yesterday. With all that movement that we saw yesterday, we didn't even actually get to resistance level 1 yesterday. However, on Thursday, look where we got. We got precisely to resistance level 2. Okay? So how will we know how far we can realistically move on any given day? Usually the market will stay within resistance level 2 on each daily move. Very seldom in fact, there are resistance level 3s out there. It's just that on the daily basis, the markets don't often move to resistance level 3. So when you're looking to set your targets, so your profit targets, you'll certainly be looking to exit the majority of your position if you're looking from a probability standpoint by resistance level 2. Todd?
Support, resistance, and moving averages, which is fine. The question I have is wondering why patterns do not play much of a role, such as flags, head and shoulders, and many more. If one has to take a look at the monthly SPY, you would see a bear flag this month, which play out to a T. Anyways, great site, Robert. So basically, he wants to know, why you don't particularly use pattern trading versus your MAs and support levels.
Well, I do go ahead and talk about, here on the multi-year chart, this is I've talked about in multiple videos, this is really a multi-year double top, pattern in the S&P monthly index. So, I do use patterns. I've focused on the fact. In fact, ironically, I've referenced many times the Edwards and McGee book, which talks about many of these classic patterns, and I've said that these patterns still work over time. The work that I do goes ahead and usually encompasses, those patterns. For instance, a W pattern or a double top or a triple top or a head and shoulders. Usually, as that pattern is forming out, it's breaking one of my key support or resistance levels. So I don't focus so much on the patterns. I do focus, if you notice, on congestion patterns, and it's just what my focus is. I will say this though, those patterns hold a lot of validity, on a daily trade. For instance, one thing you do hear me talk about quite a bit is the divergences. And the divergences usually go ahead and are part of a formation, whether like a mini head and shoulders type pattern on an intraday basis. As many times what they are, because you'll have a situation like here, you have a left shoulder, the market comes down, makes a lower low, and you really don't have the market moving as low as you did here. Let me get my highlighter on. Okay, Robert, you have to remind me there. Left shoulder, your head, and then your right shoulder. So you get this little mini patterns. But on an intraday basis, they're not as easy to spot as they are, let's say, on a daily basis or a longer term basis. I have gone ahead and several times pointed out bear flags. I've pointed out pennants in past YouTube videos. On an intraday basis in the channel, I do not point those out. But on my YouTube videos, I have actually gone ahead and a number of times pointed out those types of patterns. You'll recall also I do focus on, let me get my little drawing tool out, where we've gone ahead and had the coiled spring. How many times have you guys seen the coiled spring? Well, what is that? It's a consolidation pattern like we're being asked about. So I do talk about them. I may not call them, bear flags or, bull flags or so on and so forth sometimes, but I do speak to the actual patterns themselves and the consolidations and so on and so forth. So, but it's just a personal preference, the way I present my material, and so I guess that is what it is. Nonetheless, those indicators or those flags, those setups are no less important for it. And I would remind everybody, on my website under Robert's Favorites, there's a book by Edwards and McGee, Technical Analysis of Stock Markets, and that. I think that's a fantastic book talking about a lot of those exact patterns going back to the early 1900s, and I've talked about how valid those patterns are. So I in no way, shape, or form discount those patterns. I think they're very valid. Todd?
Okay, great. I do have one question to add to that, because I remember getting this in the chat room this week, funny enough, is, with the patterns on the price action, that's one thing. What about patterns on the indicators like MA and in particular RSI with, the fishhook setups? Do you pay as much attention to those versus the price action?
Excuse me. Yes. You recall from last week's webinar, actually, let me get the tool off here. Let's go back to the concept of the fish hook. I've gone ahead and actually said that I kind of like looking at both of the price actions. Let me convert this to a line tool. If I can get the fish hook to show up or the broken bent finger pattern to show up, either one of those two patterns, on both the indicator, or the price action itself, as well as the RSI, that strengthens my conviction for the move. So I did go and indicate that in last week's webinar. I do like to see it. What I look for warning signs is where one of them, in fact, here's actually this one worked out okay. What I'm looking for is where one of them is more extreme than the other. Here's a case in point. It worked, but nonetheless, I don't like it as much. This RSI pattern here. This one looks nice. It's about a 45-degree angle, okay, where it comes down and goes back up. This here comes down and goes up a little bit higher than I would really like, almost to the 50% of the previous move here from, let me get a tighter tool in here to mark this with. From here down to here, it retraced back up about 50%. That's where it starts getting risky, and anything over 50% I don't want to trade. So when we're looking at the fish hook coming down, I like it to be, at nice 45-degree angle and make more of a check mark, the broken arrow, the fish hook that I call it. I don't like it to go ahead and be at a steep angle and up here above this 50% level. Okay, those are some of the rules I look for when with the fish hook. Same thing is then with as it relates to the RSI. I like this. I like the same thing to happen with the RSI. I like a nice rise, a shallow pullback, and I'd like then the price action to be a rise and a shallow pullback as well. Okay. Todd, does that answer your question? So I do look for that, and I did mention in last week's webinar, I do use the indicator, in this case the RSI, as part of that confirming tool if possible.
Great, yeah. I just want to throw that out there since I know a couple of people asked me that in the chat room this week.
Okay.
Next question is, I need clarification on the 20-period moving average. Let's say price is pulling back to the MA on a 5-minute chart, but at the same time, it is a long ways away from price on the 15-minute chart. Which do I take?
Well, I tried to make my preference really clear on this over time that I prefer to trade off of the 15-minute charts. I know there's a lot of people like trading off their 1-minute charts. There's a lot of people that like trading off their 5-minute charts. But from my perspective, I found that a lot of the analysis that I use, and a couple of people that have switched to that time frame have indicated the same thing, which is that the 15-minute chart seems to work best because to the point that the viewer made is that if you take the trade on the 5-minute chart, but you because it's at the 20 period on the 5-minute, but it's way away on the 15-minute, it's more likely to potentially fall against you and fall more down towards that 15-minute chart. My personal preference, my experience has been the 15-minute chart is more ideal. What I would say is if you're going to use a 5-minute chart, look at some of the other moving averages then too, like a 50 period and a 200 period moving average. Put those on there and see if you can get those levels to agree and tie into a level on the 15-minute chart so that you're getting some sort of confluence of circumstances versus just your 5-minute charts giving a signal. Because if just your 5-minute charts give a signal, unless you're going for a very short-term trade, you suffer the strong possibility of having it move more than a point or two or three against you, and then you get stopped out before then the 15-minute chart kicks in, and then you go ahead and suffer a loss when you could have waited a few extra minutes for the 15-minute chart to kick in as well. So my preference has been, and probably will be for a long, long time to come, trading with those 15-minute charts far more than I do the 1-minute and the 5-minute charts. Todd?
Okay, great answer. Next question will be, what is the relevance, of the 3 and 5 simple moving averages?
Well, the relevance is that I use those as kind of speed lines in the market. And what we're talking about here is I look for those to go ahead and break below the 20-period moving average. And then if we're in a strong trend, generally what you'll see, let me get the highlighter up. When we're in a strong move, you see they like to normally only pull back to the speed lines versus all the way back to the 20-period moving average. And if you go back and watch a lot of my YouTube videos, when you can just see right here and just on the chart I'm showing you, that's the case. So, I look for a break above the speed lines, the 3 and the 5 to get above the 20-period moving average, to break below it. So it's kind of showing me a trend. Here you see the 3 and 5 got right up to the 20 period, went ahead and pulled back, and then as we're making this bottoming pattern, it went ahead and finally broke out, more convincingly. The speed lines for me, though, the way I use them, if we're in a strong trend, I don't foresee us pulling back to the 20-period moving average, because like here, you broke out to the upside. If you waited for it to pull back to the 20-period moving average, you never got to go ahead and take a trade. If you started scaling in here with the 200, where the 200-period moving average was, and the rising speed lines, you are more likely to at least get a scalp out of that trade. And that's what I do. I use them in a rapidly moving market as the support and resistance levels of choice versus waiting for it to pull all the way back to the 20-period moving average. Todd?
Okay. Our next question is signs to say as price action reaches a support and resistance level. Signs to say. I really don't know how to answer that question. But a lot of people asked it. Signs to say in as price reaches a support and resistance level. Oh, thank you. Thank you, Joe. So, I'm sorry. I have it in smaller print so I can have everything on my screen. It's signs. What signs do you look for to stay in as price reaches a support and resistance level? Thank you, Joe.
Gotcha. So this was operator error, huh, Todd? Is it Todd? Nice. Um, okay. Well, signs to say, well, first of all, as part of a sound strategy, you know what you have to look at here is a couple of things. Let me get my highlighter back up. If you're taking a long position, let's say down in this area here, you see there's a support level, or excuse me, a resistance level here, and then you see the next one is here, and the next one is here. I've taught in my YouTube videos about, you know, taking profit off the table, because if you look at this, let's say you took a trade right here, okay? Not that this is a solid 2-bar setup by any means. I just use this as an example. You took a trade right here, and you hit the resistance level. What happens if you go ahead and you hold the entire position into this area, and then you go ahead, if you get out of the position entirely because you hit the resistance level, well, you've made a profit of a couple of points. Otherwise, the other risk you have is you get up to here with all your position, you don't take any of it off the table, and it moves against you. And here, remember, you entered here, and now you find that you're 2.5 points against you down below. Next thing you know, you're like, oh no, I just turned a winner into a loser. I'm going to get out of this. You lose money, and the thing turns back around and goes back in the other direction. I would submit to you that it would be a more sound strategy than when you hit the resistance level. It's a known resistance level. For anybody that's been around my videos for 8 months or more, you know how well my support and resistance levels work. So one thing that you could say to yourself is, okay, I don't know if this is going to keep going in my direction, but I do know this is an important resistance level. So what I'm going to do is I'm going to take 25 or 50% of my profits off the table. I see that the 20 period is rising. I see that the 50 period is starting to turn around, but I don't know for sure what's going to happen because none of us do without a crystal ball. So what happens is you could, to be more sound, is since you don't know if a resistance level is going to be the final hold. Now, I would say this, if you go ahead and if this happens to be resistance level 2 on the day, on the pivot points, combined with one of my resistance levels, you're far more likely to go ahead and hold that level. In fact, I would submit to you, remember I just showed you yesterday, this was resistance level 2 on the daily chart, okay? So let's just give a live example of what I'm talking about. Let's move this over a little bit. Yeah, let's get this one. Okay, so here we are. This was resistance level 2 yesterday in the market, and it was right at my resistance level. Okay, so now you've got a whole lot of reasons between those two things to say, wow, we're at Robert's levels. We're at a resistance level 2. You know what? This is a far less likely reason to go ahead and continue to move forward. I'm just going to exit this whole trade. Okay. Now, if we're earlier in the day, so we're down in this area, and we go ahead and we get up to it, you've bought a pullback of a rising 20-period moving average here, and you get up here, you could say, okay, well, first of all, we got a whole day's trading ahead of us, plus we just bounced off the primary pivot of the day. That's what this was right here. Let me get my little highlighter on there. Okay, actually, you know what? Sorry. Get this one for you. Okay, so here's the primary pivot of the day. This is resistance level 2. So here you've got a rising 50-period moving average, a rising 20-period moving average. You got the resistance level here. If you went ahead and bought through a break of this level here, and you then, because you bought the pullback is what I'm saying, to the rising 20-period moving average, you know your first resistance level is right here. So a sound strategy is still taking off 25, 50% plus of uh, your trade right here for a profit, moving your stop up from down in this area up to break even, so that if this thing turns right back around and comes down, you get stopped out at break even here, but you've made a profit on the rest of this trade. If the market keeps going, though, because you're early enough in the day and you were only at the primary pivot, which was, again, showing how nicely it was holding as support, then you can let it run into the next level. And then you can say, you know what, now I'm at resistance level 1, which also, again, happens to tie with Robert's levels. I'm going to take the rest of my trade off here, or I'm going to take another 25% off. So now you took, let's say, 50% off at the first level here. You take another 25% off here and see if you can still get any more action. Or you just exit the rest of the trade right here and say, you know what, bears make money, bulls make money, pigs get slaughtered, don't be a pig. So, that's how I would play it. You'd never know if a resistance level is the final end all of the day. But when you combine it with where my resistance levels are in this case, combined with where you're at in relation to resistance level 1 and resistance level 2 on the daily pivots, that will be a much better roadmap for you to determine how much you should take off, if not the entire position at that time. Okay? Todd?
Okay, great. Our next question is, when do you know when the trend has changed after a divergence, like a bullish or a bearish divergence?
Well, let's go ahead and clear off some screens here. Put things back to good. You recall on the chart here, one of the things I told you back, this goes back to my YouTube videos. I like to reference this because, a lot of people understand that I give a lot of great information in my YouTube videos, but not as many people as I think I'd like to have understand that. So I like to show how the things I teach in the YouTube videos still apply. And actually, here's exactly what you should be looking for, and that's why I still show this today on my YouTube videos. This is the Dow Daily chart. You notice I show this pretty much in every YouTube video. And one of the things I taught was, here was a bullish divergence, okay? That's where the arrows were. And then this was the downtrend, okay? So what should have happened here is, what happens with these divergences is you get these little humps, okay? So the price is going down, and then the humps are getting shallower. Okay, that's the positive divergence. So what should happen then is that you should break to the upside here. Okay, in this case, right about, in this area here, we should have broken and started trending up. Instead, what happened was the market started rolling back over. And this is a failed divergence. And why is this so important? Because a failed divergence is as strong of a signal as a divergence that actually works. So that's why I want to go ahead and share that with you. What you're looking for is that point where the divergence should go ahead and cross back positive. Instead, it fails and rolls back over. And that's why I kind of highlighted the point here. Let me clear the screen. You see on this bar, and I still have it marked to this day on there, how we went ahead and actually then started to roll back over. We should have been crossing positive here, and we actually had this down bar on the histogram. See that? A significant bar down. We should have gone ahead and actually, this should have been rising positive, and this whole price action should have gone ahead and been rising here. So that, I'm trying to demonstrate two things here. How do you know it's working? Well, price would have started turning back up here, and the indicator, the histogram in this case, would have gone positive. How do you know it's failed? When you get your little lumps, in the shallow humps here, and instead of going ahead and going positive, it starts to roll back over again. Okay, so that's how we kind of know whether it's working or whether it's not working. Todd?
Okay, great. The next question is, uh, when, if ever, does the cash market, SPX, I'm assuming he's referring to, seem to lead the futures? Does it make sense to try to follow this?
In my opinion, I do not believe you need to go ahead and watch the cash market as nearly as closely as the futures market. There's a host of reasons. I could probably talk about that for a couple hours. So in the interest of going ahead and keeping this succinct, um, my experience is, let me just put it this way. When I was a stock trader all through the 90s and driving myself batty every single night, looking at hundreds and hundreds of stocks, looking for just the right setup the next day, back in the day when I was actually crazy enough to still do that, before I got wise and realized, geez, I can just trade the same instruments every single day, like with the futures, and have the same things happen every day, and it's a beautiful thing. Is that when I was a stock trader, I used the S&P futures as my guide to stocks getting ready to move. Okay, well, let's put this in English. Individual stocks go ahead and create the index. Then if the futures move quicker than the individual stocks, then by default they kind of move quicker than the individual index. I generally find, as a matter based on that fact, I generally find that the futures move quicker. It's one, instrument that where a lot of concentration of cash can come into or out of very quickly, and so versus the S&P 500 cash index is 500 stocks. It's a basket. So versus the S&P futures, it's one instrument. I tend to find that they move a little bit faster in the futures. So no, I personally don't see a value of monitoring the cash in the middle of the trading day. As an overall analysis of the markets, I absolutely go ahead and find value, such as looking at the Dow Jones daily industrials, looking at the S&P monthly chart. For the long term, I certainly find value in looking at the actual cash indexes. In the short term, though, in intraday trading, and for that purposes and keying off a trade, even back when I was looking at the stocks, if I was trying to front run, if I was looking at, like Amgen and a couple of other stocks I used to trade, back in the day and stuff like that, I would look, for sell pressure or buy pressure to be coming into those futures as a lead off or a queue up for my stocks. Todd?
Okay. Next question is, when a potential trade sets up, what other factors are you considering before entering the trade? I.e., do you use the VIX chart? Does it have to be above a certain moving average? And I know you have that, as a tangent, you have that VIX with the Bollinger Bands chart. That might be another thing. Do you use ADX heading in a certain direction, or just a nice separation between the lines?
Okay. A nice separation between the lines. What was that, for the ADX?
Yeah,
Okay.
I'm assuming so. It's right after that, but it did look like an additional question. So.
Oh, okay. Well, there, there's a lot of things I look at when we're talking about going into a trade. Um, some of the key things that I'm looking at, let me just kind of I'm resetting my charts here to how they would look so I can give you the hit list of some of the things that I'm looking for. Okay. So this is my primary master trading screen, as you know, that I've shared in depth and reviewed all these individual lines and settings and everything in my indicators webinar. So I'm not going to go through all those, all over again today. However, what I'll say to you is that there's a couple of things I'm looking for. If I'm looking to go long, for instance, okay, I don't want us to go ahead and be right at the primary pivot of the day or the resistance level 1 of the day. Or if I'm looking at going long, I don't want to be at one of my key resistance levels. Okay, I don't want to go ahead and be, and I've got my VWAP and other types of moving average charts that I have up here. I don't want to be right at any one of those if I'm as a resistance level if I'm looking at going long. At the same time, I like to have, if I'm looking at going long, my RSI above the 50% level, as we have here. and I'd like to go ahead and have my ADX trending positively if we're looking at a longer term trend. If it's a scalp, the ADX is not as necessary. So what we're looking at here is that I've talked to you about the ADX and how I want it to be rising. We talked about that in past webinars. So what I'll say for today is that what I like is for there to be this healthy spread. Maybe that's the person that watched my past webinar that knows that I'm looking for the positive DMI to be rising and the negative DMI to be falling. Okay, so I'm looking. That's why, and then let me go to the VIX. The VIX is basically a counter trend indicator. If it's going up, the S&P futures are likely going down. If it's going down, the S&P futures should be going up. So what I'm looking for is the VIX to go ahead, and ideally then, if I'm looking to short, I want the VIX to be above like the 50%. If I'm looking to go long, I kind of want the VIX to be below. And you see we dipped below the 50% level here, and that's when we started to get that late day rally. So there's kind of a confluence of different things on a whole bunch of these charts. I do a kind of a systems check across the board as I'm looking at this, based on all those indicators. That's why I did a whole webinar on just my indicators, because I wanted you to know what my indicators are that I look at, both my master screens such as this, and then on a daily level as well, some of the indicators that I'm looking for. And but this gives you kind of the quick check, above or below the 50% level. If I'm looking to go long, do I got a rising 20-period moving average? Am I at a resistance level on either my levels or a pivot point level? Am I above the 50% levels? Is the DMI going the right way? Is there anything saying, wow, I'm about to go long at the absolute worst time and this thing is going to pull back on me? Okay, that's what I'm looking for. Same thing to the short side. Okay, we break my key level, one of my key levels, let's say here, we're coming down. Okay, we break this, but am I about to find out the primary pivot of the day is right here, or any other, magnificent level that's of importance for the day? So I want to have this system check, which is why I have my screen set up this way to look at all this to give me a go, no-go decision. So I look at a lot of different things, of which I just covered. Todd?
Boy, Robert, that answer and question was probably the single best, most informative thing just right off the bat, because it was just a very comprehensive thing. So that was a really good one. The next question is, what is your pre-market and post-market analysis?
Okay, pre-market and post-market analysis. Well, let's go ahead and erase these things. As far as pre-market analysis, the first thing I'm looking for is, and you notice I talk about it in the daily chat room, I talk about key levels. And a lot of those key levels are derived from, where I'm looking for a breakout or break above is where did we trade in overnight trade? So where was the challenge? For instance, here, let's go ahead and get the highlighter on it. This is overnight trade. This is, 5 o'clock Eastern time, 6 o'clock Eastern time, 8 o'clock Eastern time. Okay, so pre-hours trade, we kept coming up to the, my 1202 to 1204 band. We hit it, pull back, hit it, pull back. So guess what? My analysis is, well, we need to break the 1204 band to go ahead and look for long opportunity, because we've proven already a couple times here that if you're looking to take a sustainable long, that you may have a challenge right here at these levels. So I look at where the market in pre-hours, by pre-market analysis, is where have the markets been struggling in overnight trade. Okay, very important. As far as my post-market analysis, it's basically where are the key levels for the next day? Excuse me. Where are the key levels for the next day? And by the way, I'm trying to mute my microphone before I cough as much as possible, but sometimes I can't quite get to it. I apologize. But where are the key markets for the next day in relation to my key levels? So basically what I talk about in my YouTube videos at night, I look back at what the markets did for the day, what levels they struggled at, and where they're trading now in relation to then what I need them to break above or below for the next day's trade to get going. And so in my nightly videos, you say, for tomorrow's trade, a break above this, a decisive break above this could lead to this area. Break down below this could lead to this level down here. Okay, and so the post-market analysis is, where are we trading? What's the next key level, and what's the key level beyond that? Okay, so pre-market, I'm focused on actual overnight trading activity. Aftermarket, I'm focused on intraday trading activity, and then where we're at, and so what we need to break out from there to get to the next levels. Do I focus on earnings announcements and all that other stuff? No. What you do know I focus on, though, is the key economic reports at 8:30 and 10 a.m. Eastern Time, as well as the actual 9:30 market open. Typically, those 3 times right at those marks, 8:30, 9:30, and 10 a.m. I don't trade because it's pretty much like Las Vegas. One time you get an economic report, and and so getting back to my analysis, I don't worry about, the jobs number is supposed to be this, so if it's not, I'm going to go short. Because you know what, guys? How many times has an economic report, here, let's put it in the terms most of you can understand. How many times does a stock come out with great earnings and still sold off? Okay? I would challenge you with that. Or how many times does a stock come out with bad earnings and it actually rallies, or they announce layoffs and it rallies, okay? What I'm saying is that a lot of times by the time the news actually hits, the market news is priced in, but not always. And unfortunately, you and I as traders don't know that. So I do not focus on the analysis of the actual economic reports. I let the market go ahead and settle its dust for the next several minutes after the report and say which way then it truly wants to decide, and then I go ahead and jump on the trading wagon. But I don't go ahead and try to analyze the reports for where I think they should go, because way smarter minds than me and way smarter minds than the majority of you are getting paid millions of dollars to try to figure this stuff out, and they still don't get it right. So keep that in mind. So my analysis is really focused on actual price action, and I steer clear of the economic reports, and then I wait for, then I do my analysis from there. Todd?
Okay. Next question is, how do you determine the congestion zone, no trading zone, versus a breakout zone for each day prior to the start of the trading day?
Okay, well, that was pretty much asked and answered actually in this last section. The congestion zone is usually, it's an area between a couple of support and resistance levels. Now, this is actually intraday trade, but it's the same concept in overnight trade. You see, when you get stuck between a couple of key levels, this is a congestion zone where you're tightening up into a area of resistance and support, and so you need, and especially in overnight trade sometimes. Let me just go back. I know we've had some really great days where we've done that. Here's a great example right here. Okay, just the other day. Look at this right here. Look at how we went ahead and just completely got into this in overnight trade and just stopped dead here. Oh, by the way, I'd just like to point out to all of you, this is again my 1204 to 1202 level, okay? So, and look at how tight we stayed in this area, okay? So, obviously, I want a break of 1195 or break of 1204 to the upside, okay? So I look at where in here, that's a congestion zone where everything's been tightening up into a tight area between one of my key support resistance levels. So, yeah, I want to see a breakout of that, like we have here, before I go ahead and look for an actual trading opportunity there. Todd?
Okay, next question. When do you listen to listen to pivot points more or less versus other indicators? So do pivot points, in your opinion, trump indicators or vice versa? I think is what they're asking.
Well, that's actually a great question. Frankly, my pivot points are, as far as I'm concerned, are just as strong of an indicator as any other indicator that I have. And again, the strongest indications are when the pivot points coincide with my support or resistance levels. Now, so what I'm saying here is if we're at a resistance level, the RSI you see here is well above 50, okay? So if I just said, oh, RSI is above 50, I'm going long. Well, that would be a very fatal mistake because you just hit the pivot, and guess what? You pull back several points, over like 6 points here. Actually, it looks like about 8 or 9 points from here to here. Obviously, you would have been long since stopped out. You would have been right that, yeah, 50, you're above the 50 level, but you can't just look at, one indicator and say, I'm going to go do this because of this indicator. So I would say if you really want to get technical, pivot points and my support and resistance levels trump the other indicators. But for my actual trades, I look for the actual indicators to agree with my support or resistance levels. Okay, so I hope I answered that clearly. If I've got an indicator just saying, oh, it's a buy, but I don't go ahead but I'm at if I'm at a key support or resistance level, I'm going to go ahead and back off and not take that trade and trade against the support or resistance level just because an indicator says buy or sell. I'm going to sit and wait for us to break that support or resistance level. And if I'm really confident and I got all my indicators going buy, I'll use one of my aggressive techniques that I taught you all last week, like a scale-in strategy. Rather than waiting for the 2-bar official setup to happen, I'll use one of my aggressive strategies where I start scaling in and go ahead and get into it a little bit early. But I'm still going to wait for the break of the support resistance level. And again, pivots are support and resistance levels. So the support and resistance levels trump the little buy and sell indicators you get throughout the day. For me. Todd?
Okay, great. The next question, or kind of two questions, are in reference to Fibonacci's. Basically, which levels do you like to use, and what time frames? And a follow-up to that would you consider other fib levels under specific circumstances, such as a confluence of pivot points or moving averages or something like that?
Well, I'm just going to go ahead and put up just a chart here because it's pretty clean, and go ahead and show you my Fibonacci's. Even though this is a short-term chart, I kind of I stick to what I talk about, and in this case, let's see, let's do it like this. The 100% level, the 0 level, obviously, but the traditional 38, 50, and 62 levels here, 61.8 point technical. These are the levels that I use. This 25, and I mentioned that previously, the 25 is actually more or less on there as an error. It's not supposed to be on there. I just haven't taken the time. I guess I can do that while I'm here with you to turn that off. So, but this should not be, the 25 shouldn't be here. It should be the 62, the 50, and the 38. And so for traditional Fibonacci analysis, I use those very well-known levels, okay? And as far as I'm not sure why that's doing that, because I'm not going to worry about it. But for extensions, though, well, they're not showing up. Let's see. There they are. Okay. For extensions, I use the 127.2 and the 161.8. Okay. These are the extension levels that I use. So that's when we're breaking out to new highs. And we've gone beyond the original 100% level. I'm looking to go ahead and look for the 127 and the 161 as extensions. So those are two numbers that I will consider, which again, those are extensions though, as you see, those were not retracements. Retracements, it's the 38, the 50, and the 62. Okay, those are the only Fibonacci numbers I'll use. I really don't use the other ones, even if they happen to agree with the support resistance level. I'll just rely on them for the fact that they were already my support resistance level. You guys know I have a great deal of faith, and you've seen those in my support resistance levels all in action. Some of those are Fibonacci based, some of those support and resistance levels. So there's really no reason for me to reinvent the wheel and try to get cute. Everybody's always looking for more and more and more tools to add to the mix, and I'm trying to keep it as simple as possible. I do use a handful of tools, but I don't try to then get cute with the tools and add in a whole bunch of extra lines in between. Kind of like pivot points. I'd like to point that out real quick, since I see some discussion on it every once in a while. Pivot points. Between all these pivot points here, there's actually pivot points called midpoints. They do have relevance at times. Basically, a midpoint is the halfway point between each support and resistance level. Okay, so like here's a midpoint. Here's a midpoint. Okay, they do go ahead and have potentially some relevance, especially on days where the like there's a wide gap. So that's why I'm trying to make this dramatic here. If there's a huge gap between a support and resistance level, the midpoints sometimes have more relevance. But in the end, what I found was it's too many numbers. It's not keeping it simple enough. And frankly, by the time you get to one of those midpoints, you've usually gone ahead and gotten to one of my known support or resistance levels anyways. So to make matters more confusing by adding midpoints, I don't do that. Same concept with the Fibonacci numbers. I don't add extra Fibonacci numbers just because I can. I use them sparingly. And so those 5 numbers that I gave you Fibonacci-wise, the 2 extension ones and the 3 retracement ones, are the Fibonacci numbers of choice for me. Todd?
Okay, great. Next question. Do you use weekly or monthly moving averages as primary intraday support or resistance? And follow-up to that is, or do you only use these in confluence with your key weekly levels?
Basically only in confluence. I don't look at my weekly chart of the S&P, for instance. What I want to point something out to make sure I'm clear on this. These moving averages on this multi-year S&P cash chart here, I've shared with you how huge these are. Okay, I've shared this in my nightly YouTube videos countless times, and talked to you about the relevance of them, and they're very relevant. However, for a daily trading basis, no, I don't use this, in this case, this monthly chart or even a weekly moving average as my support or resistance levels. Again, by the time it's gone ahead and that's a factor, it's probably already on an intraday basis at a 200 period moving average or one of my support or resistance levels as is. So I'm not adding more indicators to the mix that I have to analyze intraday. And to that point, you'll notice that I have my charts broken down, if you remember my different webinars, intraday, daily, and monthly. So, the intraday, the daily and the monthly ones, I don't really look at intraday. I just look at my intraday charts. So, which many of those, not all, but many of those are right here on this master screen of mine. So, I'm not adding more stuff to the mix. What happens is, folks, I think that many people start suffering from analysis paralysis. You go ahead and you have so many charts on so many different screens at so many different time intervals. By the time you actually get all those messages in your head to say buy or sell, the move is over. So I try not to add too many external forces, of which the weekly or monthly moving averages on an intraday basis, that's too much information for me. Todd?
Okay, so the last question for this section, and then we could probably open it up for open forum questions, is last week you talked about rising ADX indicating strength direction. Do you ever consider a falling ADX as an indicator of losing interest in a direction?
Yeah, great question. Great question. The short answer is yes. Let's go ahead and tell you what. Let me get a different chart for you here. Let's see. Now, this is a chart that I use for specific purposes. I've taught you in the past at the other webinar, but I want to go ahead and show something for you real quick. Okay. What I'm looking at here, when you've had a rising ADX, okay, you see it was rising, the trend was rising. Now, rising ADX just means that whatever direction the market's going is strong, okay? So you can see here rising ADX when the market's going down because we picked up momentum. Now, what I want to show you then is there's actually a counter signal there, which is when the ADX starts falling after rising, it usually in the short term then means, like in this point right here, let me get a different marker on here now. Like here, as we initially take the turn back, there's usually a little bit of a trading opportunity in the opposite direction of whatever way this market was going this way, okay? So the short answer is, just like here, it was rising nicely with the rising trend. As soon as it broke to the downside here, you see you had a nice trend start forming for a while to the downside. Same concept here. So I get sorry about my drawing, but I might kind of move that off the center mark there. This thing started rolling over and gave a little bit of an opportunity for some sell side here in the short term, okay? So not very much in that case, but usually when you've had a strong trend and it starts to reverse the ADX, it means whatever trend was in place is weakening, so you can go ahead and look for potentially an opposite side trend. But I will say this, with that being said, that is a higher risk trade. Just as we saw here, yeah, it went down to the tune of about 5 points in this bar here, but then reversed back up because the overall trend was strong. Same concept here. The overall trend was down. It had the counter trend rally to the upside and then started to roll back over again. So it's higher risk. What you'd like to be doing ideally, I would encourage you to do, if you can, is jump on trends where the moving average, or sorry, the ADX is rallying in the direction of your predisposed trend. So here, the market's going up, and so as the indicator, you should be looking at long side trades because showing that the trend is far more strong that direction. Here you get the little pullback, okay, so you stay out of the trade, and then it starts to go and resume the strength again. Then you go ahead and look on jumping on that trade again. So try to trade with the direction of a rising rising ADX, because of the fact that that's usually the stronger, more prevalent trend. So what you're doing is you're strengthening the odds of success in that trade. Okay, that's kind of an important concept if you're trying to trade on the right side of the trend. How do you know you're on the right side? That's one of the ways here. Now, with that being said, I'd just like to point out to you that it's the same concept on a longer chart. You see this is a 15-minute chart? Let's go to an hourly chart. Okay, look at the hourly chart. Same exact concept. Here, you're rising. Well, look, you had a multi-hour sell-off. Here, you're rising, multi-hour rally. Okay? If you're trying to get in the direction of longer-term trends, my recommendation to you is try to go ahead and trade with the rising ADX if you can. And by the way, my settings on that particular ADX is a 13 by 8. A little bit different than the customary traditional one. So, Todd, I think you said we're opening up the regular questions now or something?
Minute break, and if we can just go to staff only audio, I have a couple of questions I need to ask you in private.
You know what? Hang on one second here. I really don't know how to go to staff audio. I tell you, what we'll do is mute I'll mute my mic. You can mute your mic. Let's go ahead and take a a 5-minute break here. Let me see what time it is. Looks like
12,
it's.
oh, excuse me, Pacific time, right?
I'm sorry, Todd. It's about. I'm showing 3:11 Eastern time. So
Correct.
let's go ahead and go to about 3:17. Let's call it that. It's 5-6 minutes. Let's go ahead and take a quick break, everybody, and we'll be right back then. Okay. So we're gonna mute just for a few minutes, and then we'll get back and start this back up with the open questions.
Muted.
And it looks like Fletch has joined us as well on speakerphone, so that's good.
Great, and I just restarted the recording as well, post-break.
Okay.
So we're all set.
The first question here is from Brian. Please teach us how to calculate your key levels specifically.
Okay, Brian. Now, Brian, I think we had this at the last or at the first webinar, the indicator webinar I did. I spent a whole bunch of time on the calculations of those. I'm not sure. How, because I spent like half an hour or something like that, if I recall correctly, showing the calculations on those key levels. Could we be more specific? Is there something specific with that I could answer? Because that was in the indicator webinar. That was the one of the crux. That was like a whole special section we did on calculating those. Is there something maybe more specific that can narrow it down to? Or we could somehow maybe table that one till later in the webinar when we've gotten a lot of the other stuff out of the way, because that's like part of a whole webinar in itself, actually.
One simple answer, Brian, would be that, like for the pivot points, Robert has given that website, MyPivots. I think it's mypivots.com or something like that. You have the pivot calculator, and you can do all your pivots based by just entering your high-low, open-close type of data, and that will generate it. And most of our platforms will self-generate a lot of these pivot points. So for that, those are kind of automatic calculations, or you can manually do it. And just real quickly, as far as Robert's levels and whatnot, those are long-term levels. So again, it does take a lot of time to explain those.
Yeah, and Brian, if there was something more specific that we're missing there, like I say, if you're just looking at show me how to calculate those from start to finish, I say I spent an enormous amount of time in a whole webinar in the indicators webinar doing that. So I can't really go through that whole process today because we'll run out of time for everybody else's questions. Because that's a big long one that was covered in the indicators. But if there's something specific, and it wasn't just how to calculate them or in general or the source of them, retype a question to Todd, because then I want to make sure we're not missing something obvious here for you.
Yeah, he's following up with, he just wondered how do you get those green band levels, and those are pretty much those confluence of various long-term averages.
Yeah, I'd say what I'll just then let me just as a real quick courtesy, go ahead and at a high level just demonstrate very quickly for all those you that came late to the indicator webinar and everything. Have patience with me for a minute. This will be quick. Just want to make sure I hit some high points. Brian, at a very high level, the source of the key support resistance levels is threefold. It's number one, like the weekly and monthly and sometimes daily pivots that are from the primary pivots from the pivot points that we talk about each day that I was talking about here. So it's like I said, daily, weekly, monthly pivots. It's also then sourced from the Fibonacci numbers that we just talked about a little bit ago. Again, what happens is, like when I look for a move from a high peak to a low peak, and then I'll sit here and find the 50% level, 61% level, and the 33% level. I will see if that seems to happen to tie with other price action that I've seen in recent past, and I will go ahead then. If it is, I will mark that as part of the level as well. And then the other area that generates these is actual price support and resistance levels, which are very important as well. And what I do with that is I will find areas that had actual price pivots. So what a price pivot is where it comes down, it reaches a point, and then rolls over. So I'm just highlighting some here for you right here. Okay. So this is one of the ways. And what's important about those levels, Brian, is that those are actual levels where price actually traded. Okay. So that's very important. You see back here, I generated one off of here, and then twice more than off of here, these two pivots. Well, look what happens. Here we come back several days later, we strike that zone, dead on, and then roll over, okay? Because price has memory. And people get trapped in certain areas in a price, and they're like begging, please, Lord, let's let it come back to me. If it does, I'll get out. I'll break even because my wife is going to leave me, my dog is going to leave me, the kids are going to leave me. Just let it come back, and I'll get out. So a lot of times you find areas that were important support become resistance, and vice versa. So there's three key areas: the pivots, the Fibonacci numbers, and actual price support resistance levels are where those support levels are all generated. And if you really want to do a deep dive and actually watch me kind of go through the process of doing all that analysis and all that, I'd recommend just looking at the indicator webinar, because I really kind of did a deep dive in one section on that. So that's it for that. Todd?
Okay, just in time, someone asked a question. And real quick, I know, Joe, I believe you had a question or two during the course of Robert speaking before, so if you could repost those questions, that'd be great. But right now we have a question.
Is this our friend Joe from the UK?
We have, I think, two Joes, actually. No, we do only have one Joe. Yeah, Joe O'Connor.
Yeah, great guy, but he's not allowed to ask questions today.
Oh, okay, let me put him on mute.
Hold on. Put him on mute, will you? Yeah, great guy. Okay. Joe, I'm glad you're here. He's been
Mike, we do have a question for Michael in the interim. Is if the VIX breaks over one of the moving average channel lines, can the opposite channel now serve as resistance or support?
Okay. If what we're referring to, I just want to make sure I'm speaking when we're talking about the channel lines, we're referring to my channels that I have drawn here. Is that right? Could Mike confirm that for me?
Yes.
Okay, great. Sorry, just sometimes it doesn't hurt to ask the obvious question, So let me go ahead and expand this chart for you real quick. And let me just explain the way. The short answer is yes, they can act as resistance. In fact, you'll find, let me go ahead and blow this up actually for a second. Case in point was just here the other day, or yesterday. We broke through the channel to the downside because, this is support. And support, once broken, becomes resistance. So we broke below it, rallied right back, and hit the channel dead on, the falling channel, and it rolled over. So Mike, the short answer to your question is absolutely. Okay, but I just want to add to that for you so you understand that the channel, I really like to go ahead and focus on using the channel as a trending identifier for me, because you see, like you notice how we had the big rally on this at the open yesterday, and then we came right as soon as we actually touched the channel, bam, it spiked up again. So, I like to go ahead and look at this as kind of a moving average, if you will, trend indicator. So hopefully you're doing that already, and then you're just wondering if you could use it then as it's a pullback indicator. If support once broken becomes resistance, then yes. But just make sure you're using it both ways for when we're in the direction of the trend, to demonstrate that, okay, you're on the right side of the trade, kind of like that ADX indicator, but then that you're also going ahead and, acknowledging it as such. Todd?
Okay. Does anybody have another question pertaining to indicators, moving averages, Fibonacci's, any kind of support resistant level?
Todd, how many sections do we have as far
We
as?
just the three. This is the first one. The next one will be set up entries, exit stops,
Okay.
scaling and stuff, and then last one is just miscellaneous, which there's not a lot of stuff there.
Okay.
So it looks like we can actually move on, Robert, if you want to proceed with the setup questions and those other questions as well.
Sure.
Okay.
And I'm
So
sure new questions will come along as you said
you bet.
originally. You said originally there was 12 questions that were asked while I was speaking, so I'm assuming that some of those got answered
They got
as I was
answered.
speaking. Okay.
That's the beauty of your tangents. You usually nail them. All
Yeah,
right. So we're
I'm
going to
sorry
move.
about my tangents, everybody. I certainly like to talk about these things and add color to them. You say something for 20 seconds and you don't add all the other stuff to it, you don't really get the meaning behind it. And I've got a lot of years of experience, and there's a lot of things I want to share, and so I'm just trying to make sure you understand it, not that, I'm just speaking for a couple seconds and giving you a simple yes, no. So for those of you that get driven nuts by people that just speak and speak, sorry about that, but hopefully it's helping most of you that I am speaking more than less. Go ahead,
Okay,
Todd.
well, let's go ahead and start with the setups and entry section. The first question will be, can you show us some of your, this is a very broad question, can you show us more of your more profitable setups? And I guess, we've already seen in other webinars the fish hook, the two-bar move. If there was anything else out there that we'd like to share, I guess that would probably fall here.
Okay. Well, one of the things that first of all, the fish hook, the bent finger, and the two-bar strategy are very good strategies. In fact, it's funny because I just got an email on that as well. The whole fish hook and bent finger thing has gone ahead since last weekend, and at least a couple people gave them more profitable trades and went ahead and made a difference for some people. So I'm pretty excited by that. And Todd, you seem to really catch on to a couple of those as well, as I recall. So there's a lot of opportunity right there. What we don't want to do is have 20 different setups out there and be a jack of all trades and master of none. What I'd like to do is focus on people going ahead and understanding the opportunity for maybe some more pullback trades. Let me open up the chart here. One thing that I think people have more of an opportunity to take advantage of that they don't would be a pullback to the 20-period moving average trade. Because what happens is the two-bar setup, we talked about that a lot last week. There's a lot of variations of the two-bar setup, and so I tried to hit some of those last week. And if there's some people that want some clarification from last week that were in the webinar, boy, here's a great chance for you to go ahead and ask those questions. But a lot of my strategies revolve around variations of the two-bar break. So keep that in mind that, for instance, the traditional two-bar break, let's go back into that for a minute, of course, is two bars decisively broken through, preferably on heavier volume, and then you get a pullback on lighter volume, and then you get a resumption of the upside. So that's the traditional two-bar break. However, the reality is that in a lot of cases, these first two bars move quite a bit, or the trend really gets going, it breaks down below, and then next thing you know, you can't look for a rally all the way back to like a 20-period moving average. You have to look for a rally back to like the speed lines that I've talked about. So I'd like to reiterate to people that one of the things that for you, those of you that weren't last week's session or so, is the scale-in strategy really offers a lot to people like that, because what you can do is go ahead and let's say this was the two-bar break right here, and it's already moved from way up here all the way down to here. So now you're looking at this thinking, gee whiz, I've only got like 2.5 points left to profit in this trade. So what happens is you can say it moved a lot. One of the strategies I taught last week was starting right at the close of this bar, putting a contract into the market right here and then looking to see if we rally up to the speed line, and then you could put another contract in. Then if we go ahead and rally up to the downtrending 20-period moving average, you put your third contract in, and then by then, either this thing is going to have already moved down right off this second bar, it's going to go ahead and fall, hit the speed line and fall, or as a last resort, it's going to go ahead and hit the falling 20-period moving average and fall. But either way, then you've scaled in. You've entered one contract here, so that if it goes and moves right down the last 2.5 points, you've at least gone ahead and made a couple points on one contract or whatever. It depends how much you trade. Obviously, you guys saw in my last week, I showed you guys even on a light day, with my I showed you my actual trading slips, my confirmation slips. Even on a light day, I was doing 85 contracts there at one point. You saw, so so one contractor for you may be 5 or 10 contracts for me, or whatever the case may be. So you have to look at how many contracts you generally trade in total, and then see if maybe you should start going ahead and entering. I really want people to focus on that, because variations of the 2-bar setup are still a higher probability trade than what most people do. Is they go ahead, what happens with the average trader is they didn't buy here, they didn't buy here, they didn't buy here, they didn't buy here, but by gosh, it gets all the way up here, it starts to break through, I'm not missing another rally again. They buy into this thing, it pulls back, moves back against them 5 points, they get stopped out, and they're losers and very upset. So, but here you had the 2-bar break to the upside, okay? So if you added a contract at the close there, you see that we already had a quick move here, which you could have gotten in and out of for a scalp. Or you see, if you added one contract here, added another contract at the speed line, and then we're waiting to add another contract here. Well, you never got down to here, but you did get 2 contracts in as this thing rallied back up, and your basis was actually right here, so you walked away with approximately 5 points of profit on 2 contracts, okay? As an example of how you can trade. So, there you have just one opportunity. So what I'm saying is variations of the 2-bar trade, which I was trying to emphasize for you last week, is more important than me teaching you another 16 or 17 different entries when you haven't mastered some of the others. Plus, as I mentioned last week, I'm very concerned about giving away a lot of other techniques or a lot of other setups out there when here we are 8 months later. I've been doing YouTube videos, and Todd, I think you've seen this firsthand yourself. I've been doing YouTube videos for 8 months, and people that have been around for a long time are still saying, now, is that a 2-bar break, or is that the pullback? And these are people that have been around for a long time. So either they haven't really been listening as much, or they're having a tough time learning. Now I go add in a whole bunch more indicators or setups. I should say not indicators, because I've shared every one of my indicators in my indicator webinar. But setups, when we haven't even mastered some other ones that are already higher probability as is, why focus on lesser higher probability trades when we have these ones right before us that people still haven't used as much as they could? So that's my answer to the question, Todd. I want people to focus on the variations of the 2-bar setup that I taught last week, and also then the additional setups I taught last week with the fish hooks and bent figures, which I think you saw, Todd, yourself as well, worked very well last week for a lot of people.
Yeah, it's personally, talking to people in the rooms and just seeing, during trading hours, it's amazing how many, like just the fish hooks. I mean, on a given day, there's like, anywhere from 4 to, 10 fish hooks, so there's a lot of opportunity just with that trade alone. And then couple that with your 2-bar moves. I mean, you got, probably 10 to 12 opportunities throughout the day, so those, I agree. I think, as we proceed, as the groups mature and hang along with us longer, I think it would be, then maybe more advanced, maybe less high probability trades down the road. But, why, I mean, if it's not broke, why fix it? I mean, these 2 trade setups are phenomenal as they are. Okay, next question will be, under what conditions do you not trade, even if an ideal setup is presented?
Wow. Great question. I'm glad. I'd like to know who asked that question. I know you're probably reading off a list that was compiled, but I'd like to go back and find out whoever asked that question because it's nice to know if somebody's actually thinking about when not to trade. Um, and with that said, I'm going to go ahead and really harp on that because, I recall somebody in the channel the other day who was kind of, frustrated that I was pointing out when not to trade. And knowing when not to trade is, as important as knowing when to trade. Because how many of you have had fantastic days? You're making a ton of money, or you're having a great month or a great year, and in one or two or three fail swoops, you went ahead and either gave back the majority of your trading profits for the day, week, or month, or year, or in a couple of trades, you gave it all back. Could I go ahead and see a show of hands real quick? How many people, honestly, nobody else can see each other's response, how many people have done that? You were trading along great, and in one trade, you gave everything back that you went ahead and made. Okay, yeah, I'm seeing a lot of hands coming up there. Um, so, you know, so I'm going to go ahead and kind of focus on that for a minute because knowing when not to trade is, as important. So I said, Todd, if you can ever help me find out who asked that question, that'd be great. The first thing I'm going to say is if I'm having a really bad day, there's a whole lot of reasons not to trade. A family crisis, a family situation. In fact, you guys recall my mom had eye surgery recently, and when that happened, I wasn't in the frame of mind that morning. I was wondering, oh, boy, is she going to go blind? There was a chance she was going to suffer retinal detachment and go blind and everything. She still actually got the second surgery coming up, so it's on my mind, but not like it was the morning of that surgery. So what did I do? To kind of get my head focused back in the game, those of you that were in the channel live that day will recall, I actually did a webinar for you guys. I went in and did a little instant on webinar, popped it up there so you guys could kind of see what I was thinking real time, to kind of get my head back in the game myself. I was seeing things, but I just didn't feel comfortable going ahead and throwing a lot of contracts at this market. And for me, money management is as important, more important, frankly, as it is for anybody else, because when you are slapping around 50, 100, 150 plus contracts, you need to go ahead and have your wits about you. So if I'm sick, and now I've been feeling good this week, but my voice, as you can tell right now, unfortunately has been down. But if I'm truly physically sick, where I'm having a hard time staying awake and achy in that, I'll step away. Um, if I have a major, family crisis, if I were married and I was fighting with my wife, or if I were fighting with my girlfriend, I would not want to go ahead and trade, especially if the fighting is about situations that you guys are having because of trading. If you're a man or a woman in this channel and you're trading, and you're having a fight with your husband or your wife because you took a loss and your husband or wife is upset because they wanted to go buy something, or they thought they were going to have money for something and now they're not going to have money because you made a losing trade, and you guys start fighting about it, what is a natural reaction? A natural reaction for many of you is to get right back in there and revenge trade and say, I'm going to show him or her, I'm going to make it all back up and more. And so what happens is, emotionally, you are in the absolute worst frame of mind you could possibly be in. You're going in and trying to make up profits. You're trying to force a trade, in most cases, that isn't even there, and you lose even more money doing that. So if you're fighting with your spouse about any reason, let alone trading of all reasons, step away from the computer. And some of you are sitting there probably saying right now, because I've had private conversations with a few of you, but Rob, I have to trade to make money. If I don't trade, I'm going to go ahead and lose money. I'm desperate. I have to trade. And I'm here to tell you, if that's the situation you're in, you probably shouldn't be trading, or you shouldn't go ahead and be using trading as your sole source of income. I would strongly encourage you, take a job at night, or for our colleagues over in Europe, it's great. They can have a day job and then come trade the American markets at night. So that's great for you guys. But if you're an American citizen and your American time zones, take a time job or something, or do some sort of part-time work to get some income rolling in, so that trading is not your only source of income. Because when you are feeling compelled to trade, and you say, I have to make this trade because I have to pay my bills, you are asking for a lot of trouble. I can't emphasize that enough. In the early 90s, I know what it's like. I was there. And so I did the same thing. And I would strongly encourage you to go ahead and think about that. Are you making trades? Are you forcing trades because you feel you have to? Because if you don't, you're not going to pay the bills. And then ask yourself, well, how has your trading been going when you felt that way? Were you consistently making money when you got upset and pulled the trigger? Or were you finding you were making just as many mistakes as you were winners? I suspect for the far majority of you, except for that 1% that anger actually makes you do smarter things, I suspect the other 99% of you probably found yourself in a more losing position because you forced things that weren't there. So with that said, if you're ill, if you're fighting with your family members, if you have a family situation, anything that's encompassing parts of your brain throughout the day and allowing you not and keeping you from focusing on trading is an absolute reason to stay out. Another reason, excuse me, let me clear my throat if I may, please. Okay, another reason is to go ahead and avoid the trade. There are a number of times when I've gone ahead and said in the daytime trading channel, both in the public channel and the private channel, I've talked about things being too much Vegas for me. Okay, so things such as the FOMC announcement, the 8:30, 10 o'clock opening bell, right at those marks there, a couple seconds before, a couple seconds after. I'm sorry, but from my perspective, I've been doing this for many, many years, and I have not figured out and I'm a fairly smart guy, I'd like to think, and I have not figured out a way to successfully, consistently trade the opening economic data, the opening bell, and the FOMC meetings. There's just too much Vegas. They'll whip up, they'll whip down, they stop people in, stop people out. I like to go and sit down, let all that rigmarole go through. I get a big kick out of reading chat boards and different things like, oh, this is the economic number, this is what it means to the economy, and this is what it means to our trading today. And then, you look as you go through the day then, and everybody expected the market to go up for the day, and it goes down. Well, then CNBC, of course, comes out with some excuse as to why it went down. The very next time you'll get the same reaction, and CNBC will come out with a reason why it went up for the day. You can't trust the news on these matters, and frankly, the economic reports will be interpreted different ways. You get 10 different people, you're going to get 12 different interpretations of the economic reports. And so, my point being with that, I do not trade right at those times because it's too much Vegas. And so you'll hear me use that term, too much Vegas, in the chat room. So those are other reasons. So those 4 reasons, economic reports, family situations, mega events, fights with the family, and or health reasons are reasons I will not trade. And I can't emphasize that financial one enough, because I've had a couple people come to me. I'm certainly not going to mention names, but I've had a couple of people come to me and say, you know what, Rob, I was trading stocks. I've fallen below my day trading margin rule now in stocks, and so now I want to trade futures. Okay, I want you guys to think about that concept. And I know some of you in this room may be in that same boat, but I want you to think about it. I'm your friend here. You guys know that. I try to tell it like it is. I try to help you and keep you guys from losing money. A guru is not going to matter, or not going to care about it. They just want you to buy the next program, buy the next thing, buy the next service, buy the next $400 chat room. I'm trying to give you guys real food for thought here, and sometimes that may rub you the wrong way, and I apologize about that, but think about this. If you've gone ahead and been a stock trader, and you had yourself a $50,000, $100,000 portfolio, and now you've dwindled it down to $25,000 on stock margin, on stock trading margin, okay? Now you've fallen below the $25,000 pattern day trader rule. So now suddenly you want to get your leverage back up and go trade futures. Okay, I want that's not necessarily the best move. I would strongly encourage you to talk to a registered financial representative and ask if you're really doing the right thing for yourself. I personally don't feel that it is. So I'm certainly not going to encourage people who tell me I've lost a bunch of money in stocks and now I want to trade futures. You're not going to see me go ahead and say, oh, yeah, you're going to make millions in futures now when you couldn't do it in stocks, okay? So I hope I didn't offend anybody with that, but I do want you to think about that. If there's anybody in this room today that's in that situation where you want to go trade futures now because because of the high leverage when you've lost a bunch of money in stocks, if you're just going to jump right into it, trade futures, I'm very concerned for you, and I would ask for you to get professional help on that before you do that. So don't go ahead and trade futures just because you don't have enough money because you lost it in stocks. Okay, so Todd, I guess I'll leave it with that. But I just really want people to take that as food for thought because I just don't want to see people hurt themselves.
No, that's great advice because that's definitely stuff you wouldn't get from a a guru type like you're saying that's just interested in money and getting you to buy stuff. The next question here is under what conditions do you immediately buy or short without waiting for an ideal setup?
Well, I do that quite frequently, actually. Obviously the things I've shared in YouTube and my webinars to a lesser degree, I've tried to share more in the webinars, but it is very conservative in nature. But I tell you, certainly one of the things that I do very frequently is if we get that two-bar setup in the market here, I will go ahead and when I'm talking about two-bar setup now, I'm actually referring to the first two bars. So I will take what I'll do is I will take a situation where we have a confirmed two-bar setup, and I will actually dump stocks in. So if I were sitting in front of the computer right when this happened, and it were not during the opening bell during the economic reports or so, if this was just intraday trading activity, more likely than not, I will probably start scaling into a trade like this, where we get the first two bars locking in a directional movement. So what's different about me versus what I preach in like the YouTube channel and stuff, for conservative nature reasons, I like to go ahead and tell people wait for a pullback. Why do I tell people to wait for the pullback? Well, because if you go ahead and you short, or excuse me, if you buy right here, and let's say we're trading at 1210, okay? Well, this market could pull back 1208. I mean, by the time the rising support hits, this could be 1208, 1207, 1206 down in here. So the reason why that's why I don't go ahead and tell people, oh, buy the close of this bar here, because what happens is you may take some heat, and I hope that if a stock would move back 4 points on somebody, that they would actually get stopped out. I hope that most people's stops aren't. I see a lot of people that go to take 1 or 2 point profits, but then they go ahead and they let their stops be 4, 5, 10 points. That's a losing game because you think about that. You take a 1 point profit, and then you go ahead and you take a 5 point loss. You now have 5 trades just to go ahead and sort of break even, and actually after commissions, you're still losing. So from a conservative perspective, I go ahead and I teach people to go ahead and wait for a pullback, because that way then if you put your first contract in here, unless you're dead wrong on the trade and it starts to break through the rising support, which will happen far less than not, then at least you've gone ahead and gotten at a much lower basis. It starts to rally back off, blasts off to the new high, and you're just making money the whole time. But what I like to do is go ahead and let me go ahead and, if I may, just clear this and redraw it. I like to go ahead when we get my solid 2-bar thrust. I will actually start entering. I'll take a contract, contract position in here, And then if I see the rising support is until down here, I'll look at the number of points. And I kind of taught this last week. So let's say that this is 6 points away to the rising support. I'll go ahead and look at dumping X number of contracts in here. I'll look 2 points away. I want to dump 2 more contracts in. Or sorry, 2 points away, I want to dump another set of contracts in. And then, the final 2 points away, I'll go ahead and dump some more in. And then, as we get down to the actual support, then I'll buy any remaining contracts I want for that position. So really what I've done is I've started entering right here, and my basis for the whole trade ends up being right about here as we get to the support level. Well, the reason why this works for me is because how many times has, okay, after the 2-bar thrust, do you get maybe just a little bitty pullback here, and then all of a sudden the 3rd bar breaks out to the upside, or continues the trend to the upside, if you will, or it barely pulls back, or it pulls back on heavier volume. There's this enormous amount of things that can go wrong with the perfect setup. As you see, there are some days where we don't even get the perfect setup. It seems like we usually get at least one good, solid, decisive breakout trade a day, but not always. And so, and even still, one trade enough isn't enough for most people, because what they'll do is, since they're a lot of them before they come to me are losing traders, they go ahead and they as soon as they make a point in that profitable trade, they get out. Well, so then they're like, well, I can't live on 1 point a day. So then they go and suddenly start trading in and out of positions constantly. So what I do, though, to get into more trades is, like I said, use this scaling strategy. It's something I spoke about quite a bit in last weekend's webinar. It's a pivotal concept in my trading, okay? Now, that being said, I'd like to go ahead and point out there was actually a question about this that was sent to me personally. So Todd, I'd like to interject on that question real quick and answer it for the person, which was, okay, you use the scaling strategy. How do you know you're wrong? Well, let's go ahead and clear the screen here real quick. If I'm going ahead and scaling into a trade, in this case, I'm scaling in, we'll use this as the example. Let's say this was a 2-bar breakout to the upside. I start scaling in contracts here. I throw some more contracts in here. I throw some more contracts in at the rising 20-period moving average, okay? If all of a sudden this thing goes ahead and has a bar that closes against me down below my rising moving average, I'm very likely going to go ahead and exit that trade, okay? Because because as you've seen with the trends, when this 20-period moving average is rising sharply, look what happens. We'll fall below the 20-period moving average, but we'll get back above it. Here, when it was rolling over, we'll trade above it, but it won't close above it. It'll fall right back below. So I use the 20-period moving average as kind of a stop area for me, and a close in the opposite direction against my trade will very often go ahead and trigger me to exit out of that trade, okay? That was a viewer question that came to me when you use this, because the person basically said, wow, the scaling strategy has been working really well for me, but what if it goes against me? How will I know when to get out? That was basically the question the person asked. First of all, I'm glad the person noticed that it worked very well for them, because I said I've had some fantastic trades. In fact, in my webinar last week, all of you will recall that were there, I showed you my actual trading statements and showed you several lines of the trading statements there, how you just saw me scaling in, scaling in, scaling in, and then exiting for my profits. It worked very well. But yeah, you have to know your limitations when to get out. And the key, and as a closing remark on the scaling strategy there, the key to remember is that you need to be taking that trade in the direction of the trend, okay? Whenever I've taken a trade where I took it outside the direction of the trend, so what I'm saying with that is if the 20-period moving average is going down, I better be scaling into shorts, not longs. If the 20-period moving average is trending up, I better be scaling into longs. Anytime I've ever tried to go ahead and scale against the 20-period moving average, it hasn't worked out very pretty. I've usually ended up having to go ahead and buy a whole bunch of contracts at the higher price and go ahead and scale out with a scratch. Or loss, as it were. So I'm telling you right now, scaling strategy is a great tool, but use it in the direction of the prevailing dominant trend. Okay. And let's see, I just want to make sure that gave me the perfect opportunity to answer that question about the counter trend trade. So if you're shorting, you're scaling into your short here, then all of a sudden this closes back up here and closes up here. That's an indication for me that I may want to go ahead and exit this, short strategy I was using because we may be getting ready to reverse to the upside. So, Todd? Todd, are you
The
there?
Yeah, can you hear me?
Yes.
Okay. One bit of clarification on that is when you do have that close above or below the 20, when do you go ahead and say, okay, close? Just at the first open of the next bar, or do you wait to see if it'll come back and then close on the other side of the 20?
Well, the reality is that a one bar close above or below a support resistance level usually is not decisive enough for me to enter a trade. However, if I'm scaling in and I'm putting a lot of size into a trade, how long am I going to wait to go ahead and see? See, what you just described to me with that question, Todd, is hoping and wishing. Okay, let's not forget we were thinking that this market was going to go down. Okay, so what we expect to have happen is this market's going to go down. So we scale in some here. We scale in some here. Okay, because we're expecting it to continue to go down. What you're not expecting to have happen is a strong rally to get back up here, and the market's so strong it's actually able to close above that 20-period moving average. That's what you did not expect to have happen. So but if you go ahead and then say, oh gosh, okay, one bar close here, well, for entries, I go ahead and I always wait for two bars. So I'm just going to see if this next bar will wait, will close too. Well, okay, yeah, you may get lucky enough; it'll come right back down into this area, but you may get really unlucky, and it goes and continues the trend to the upside, kind of like like here, you get a super powerful rally going, and you go ahead and let's say you short it up here and the thing, so you're adding shorts and all of a sudden it starts going up. You can hope that this next bar is going to come right back down, but that can be hoping and wishing, and you can find yourself getting stopped out at some really ugly prices. And if you're scaling into a trade like that where you've been shorting and you got a whole bunch of size, I mean, let me tell you, you scale into the size I have and you start going ahead and letting things go many bars ahead against you, you're going to be talking about 20, 25, 30, 35 plus $1,000 losses. So, I'm not going to go ahead and let it sit there. You have to go ahead and consult with your financial representative to see if you're willing to wait for two bars. But I'm really not willing to wait for more than one bar. If it's been going down and it goes all the way back against me here, I'm not going to wait to see if I was, and hope and wish, because that's all I'm doing at that point. I'm hoping and wishing, please, please let it come back down, okay? And by the way, this was a close. This was a closing bar. Then this was the open of the next session down here. You see, this was not like back-to-back, like, live trading per se. So, usually if you get that where all of a sudden it strongly reverses, well, I mean, I guess here's case in point, okay? Right here was the market was downtrending and it was falling, so you're scaling in. You have this huge bar up. So do you wait to see if it comes all the way back down? If you do, you may be sorely disappointed when it makes a new thrust up and you're caught losing even more money and panicking out at much higher levels. So for me personally, now I'm usually looking for a one bar counter trend break to the opposite direction, if I'm scaled in with heavy size before I'll get out. Todd?
Yeah, that's great. Because actually on yesterday in the room, I had a couple questions from people about it was basically that 10 o'clock bar, that red bar down, the drop below the 20. And they were asking pretty much that same question. It's like, would you get out of the trade right now? And I was saying, well, you kind of have to see if it's going to break that, because they were going long, and they chose to hold on, and they got lucky on that one. But
Well, if they're going long, though, they should have been buying a support level.
Exactly.
So
But I think what they were doing, they were buying right off
up here,
hit of the first hit, yeah, right off the bounce there when it pulled back to I guess that's your 200 there, that pink line. They were buying there, and then then it broke down and closed below, and you got a couple of spikes in a row.
Well,
So
you
they're
had this.
asking,
Okay, yeah, I see. You had this one. The thing was that you really still had a rising 20-period moving average on this one, but the one bar that closed below was, I mean, that's not really the kind of bar I was kind of illustrating below. I mean,
you're
if you
talking
look,
big
what is? I mean,
bars.
look at the size of that bar there. I mean, it does kind of make a little bit of a difference that the bar came right back to it. I mean, you know, I can't spite somebody for holding on when it closes 2 ticks, or basically that's what that was. It was about 2 ticks
Yeah,
below the bar. I can't really spite somebody for holding on there. What I'm referring to is this concept here, where you're going ahead and having a wide range bar that's going the opposite direction, showing that something fundamentally has potentially
gotcha.
changed in the market, such as like we saw here. These wide range bars showing real exuberance, excuse me, in the market, but an indecisive kind of really small bar, and this whole bar was indecisive. It was kind of a doji. In fact, you had 3 dojis then, which then led to powerful rally. If something's like right here, I want to show this one. If you have downtrending 20-period moving average and you get like a little doji, am I going to spite somebody for going ahead and holding on a little bit longer? No, but then what I would say here is look at your other indicators and ask, why is this doing this? If you're shorting down here and all of a sudden we don't make a lower low, that's a problem. Okay, and I see that ultimately it went down here later, but when you don't make lower lows, remember what a trend is. A trend is higher highs and higher lows to the upside, or to the downside, it's lower highs and lower lows. So we were kind of breaking the trend here in early morning hours, and you got to sit there and say, wow, what's going on? I'm getting back up to my 20-period moving average. It's starting to flatten on me here. But again, this is one of those reasons I don't like the real early morning trade, because pretty much anything can happen on the light volume. But I'm trying to give you some ideas, some concepts here of how I'll sit there and think about this. So a doji star close at my falling, if I'm short, at my falling 20-period moving average is not necessarily oh, I got to get out situation. What I'm referring to is when the bars dramatically move back against you in the counter trend, such as right here, classic example, huge bar going ahead, taking out, this was like 6-7 points, I believe it was. This should have been short, and this should have been a 6 or 7 point drop to the downside, and instead it's a huge bar to the upside. This is a sign when you get one bar that takes out 3-4 plus of your previous bars to the opposite direction, there's a sign. Todd?
Great. That's good. Good follow up there. Okay, our next question is basically set up a checklist, and it looks like an algebra question here. It's ABC equals setup formation, ABC plus DE equals setup formation plus added confirmation, more conservative in quote in brackets there. If you can clear up some of the gray areas, like yes, it was a pullback, but not great quality. So I guess what he's saying is, how do you differentiate between a higher and a lower quality 2-bar setup, for example?
Well, and I think what's happening is you're finding people who are trying to focus on just the science and not the art of trading, and this kind of goes back to trading in general. People want to go out, and unfortunately, that's why I have such a hard time with the whole guru thing, because it plays right into those kind of people. People want to go out and they want to pay thousands of dollars for the magic indicator. They want to go out and pay, $5,000 or $10,000 for the class that's going to give them the secret to all success in life. And the same thing with here. I think what I'm hearing is people want to hear the exact science of every single setup. And that's pretty much what I'm hearing out of that question. Now, what I can do, and actually this question kind of came up in the student room a little bit. Maybe make some more examples. I think what I will likely do here is go ahead and create some more examples. What would I call, like picture perfect setups of what the setups should look like. I tried to show a lot of examples last week. If you're calling the setups, Todd, where I went ahead and was showing like the angles for like the fish hook, for instance. Don't want this kind of stuff. Don't want, I kind of showed them what I do want, kind of the 45-degree angle kind of stuff. So I showed some of the do's and the don'ts and stuff like that. I think what I'll maybe do is try to create some either pictures or videos of the ideal setups. But for me to go ahead and sit there and document out every variation of every potential trade, part of this is going ahead and taking what I teach you and applying it to your methodology, because people have different risk tolerances. Their brains, frankly, move at different speeds. Some people may go ahead and not see an indication where we have a hook. In fact, Todd, I taught that video last week, and some people, were calling out fish hooks in advance. Some people, were like never seeing the fish hook, even after it fully happened and matured and everything else. There's people that move at different speeds with their brains. And so, what I can do is highlight the correct setups, what they should look like, and then people will have to learn those setups and then go ahead and have to commit them to memory so that they will hopefully see them sooner in the in the future as we go. I was pleased to see how many people did go ahead, though, and use them, saw them. I liked getting a couple of those notes that I got last week from people, how it dramatically improved things, overnight for them. That was great stuff. So, but but there's other people though that are just like, is that a fish hook? And then there was other people that were calling the bent finger, a fish hook and stuff like that. So I think it'll help to create some what I call picture perfect setups for people. But to document out this whole A, B, C, C, D, F, G, H thing, I don't think that's going to go ahead. I'm not going to whoever that person was, I'm probably not going to be able to give them exactly what they were looking for. What I will be able to give, though, is some examples of, this is what they should look like. This is a textbook example of what I'm looking for. And as far as variations of the 2-bar setup, well, we did actually discuss a lot of those in last weekend's webinar. What happens when, and we actually to a lesser degree discussed them today. What happens when you get the 2-bar break below the resistance level and it doesn't pull back? Well, okay, so what does that look like? Well, or how do you trade that, more importantly? And that's why we talked about the scale-in strategy at length last week, to go ahead and give people opportunities, because the picture perfect setups in the 2-bar setups, I can again illustrate those, but what's going to most likely happen is there's going to be, as you've seen in real trading, countless variations of it, and I'm not going to be able to document out every variation, certainly not in a timely fashion for people, in the short term. So I would encourage people to learn these actual concepts as I teach them, and then go back, look at the charts. Like as I recall, I encouraged people last weekend, spend the weekend if you could, look at the webinars over and over. I tried to send out the link as soon as I could. Take a look at those setups and go back and see, in the last several days trade, if you could start seeing them. And some people did that and were able to start seeing those hooks, those patterns, see more variations for the 2-bar setup that they could take. So, I would encourage people to keep working on that. In closing on this, I will try to go and put together some picture perfect presentations for people that I can maybe post somewhere at a later date here. But for all the possible A, B, C, D variations, I'm not quite sure that that's going to happen anytime soon. Todd?
Great, that's fair enough on that. Okay, our next question. On your classic 2, I'm assuming, or again referring to the 2-bar clear of a support resistance level followed by a retracement, then return to trade direction. At what point do you enter the trade on the 4th candle, question mark, or when it has closed? So you've kind of already answered that, but if you want to maybe elaborate a little bit more.
Sure. If I heard you correctly, there was, okay, you got the 2-bar setup, assuming it's the kind of classic setup. So you get 2 bars rising volume underneath those two thrusting bars. So in this case, this is a resistance level. Then we get a pullback to a rising support level on lighter volume. That's a classic setup. If I'm hearing correctly, where is the place to enter at the close of the third bar or at some point in the fourth bar? Is that what I'm hearing from you, Todd?
Yes, basically entry.
Okay. Now here's there's two ways of doing this. There's the aggressive and there's the conservative way. The aggressive way would be to enter at the close, on the close of the pullback bar. Okay. That would be the more aggressive strategy. The less aggressive strategy would be to wait for the fourth bar to open up, see if it trades down, because remember, in this case, we're going long. See if the fourth bar will trade down for a little bit and then resurge to the upside. And what you would want to do there is go ahead and put a buy order in, or what I would look at doing is put a buy order in then right near the opening tick of the that bar. So what's happening is, let me clear this off and show you a example of that. In fact, let me stop using the marker too and use the pen. Okay, so you have bar 1, you have bar 2. Then you go ahead and you have a pullback bar where it closes, down. This is like a little bar chart example here. And then so then you got like rising support here. So you have a couple choices. The aggressive strategy to trade with this conservative approach is to go ahead and just buy right to close this bar. So if the next bar, because what frequently happens is, I'm sure a couple of you have seen, the next bar will open up and take right off to the races, especially if the support level is really close. Okay. However, what happens sometimes, though, is that the next bar here will actually trade down first, fake some people in short, then go back up. So what you could do is, if you want to be a more passive, conservative trader of this setup, you wait till that fourth bar, you wait to see if it trades down below, and then trades back up towards your opening price, and you put a buy order in somewhere in this area here, so that as it comes back from these lows back in, you get taken into the trade as it starts to rally and come back up, because that's what happens. It pretends like it's going down, gets some people short down here, turns right back around and goes back up, and then all these people start saying, oh no, I'm on the wrong side of the trade. They start adding buy pressure. You're already sitting in the trade nice and pretty, and they're just lifting you off up to the next resistance level where you can exit your trade. Okay, so there's the more passive way, waiting until the fourth bar and waiting to see if the fourth bar trades lower first, or there's just buying on the close of the third bar in this example, with it being a long side trade. Todd?
Okay, great. Our next question is, I usually wait for the exact end or suppose close of the 15-minute bar to get my entry to check if it failed break level. Is that a good approach? And basically, you just answered that. And,
yes. Whoever answered that, I'm glad that they go ahead and they've asked that question, though, because people, what will happen is, here's what happens. You're sitting there at 1:13 in the afternoon, right? And all of a sudden, this bar just looks like it's selling off. It's just dropping like a rock, okay? And then, but what happens is, next thing you know, so you short, right? Because you're like, oh, that bar is going to lock in. It's going down. Oh, look at that. It's going to be my second bar down below this, resistance or support level here. I'm going to get it, right? So that's what happens. So you've already had one bar here. I'm just using this example. You've got one bar here. The second bar goes ahead and trades even lower. You're like, that's it. I'm going to front run this thing. I'm going to go ahead and get on in here and ride this thing all the way to the bank. Well, what happens? How many of you, if you paid attention, you've seen this plenty of times, how many of you have seen, okay, you get into that trade, the next 2 minutes or the last 30 seconds of a bar, it turns right around, rallies all the way back up, closes less than 50% off the low, and then starts to go up, actually, and you're caught totally on the wrong side of the trade. So my point is that absolutely wait for the close of the bar. Too much happens near the last several, especially like certain time frames. Like at the half hour levels, 8:30, 9:30, 10:30, and 9, 10 o'clock, because people who trade hourly bars, you're up against them on the 15-minute charts. So you got people making in mutual funds usually make decisions on hourly or higher type charts, hedge funds and stuff like that. So they're locking in either at the half hour or the hour, depending on whether they use overnight data or not. And so you're going to see sometimes bigger moves around there where they're trying to front run. So what a bar looked like it was going to be prior to the close won't be that same bar 2 minutes later. So definitely wait till the close of the bar wherever possible, unless you're extremely hyper aggressive. And if you lose on that next bar, don't blame anybody but yourself because you're being very aggressive. Todd?
That's the next question here is, I typically like to trade on a 1-minute chart, and he's asking if you like to. And then furthermore, he says, what difference do you employ for setup entries and exits on a 1-minute chart versus your 15-minute chart?
The only time the only time I actually use a 1-minute chart typically is on my VWAP, that I showed I showed during the indicator webinar. I don't really like to trade personally off 1-minute charts. And now we all have different styles. We all come from different backgrounds. We all move at different speeds. I'm not that old, but I move pretty slow, especially when I'm trading the kind of contracts that I trade, the size-wise. I'm not looking at a 1-minute chart. I'm not looking to scalp a quarter tick, half a tick generally. I'm looking for bigger moves over with longevity, which is where my 15-minute strategy kind of come from. It's aggressive, but it's not multi-hour aggressive. So I really don't like using personally for my style of trading the 1-minute charts. Now, that being said, let me go ahead and get this here. Actually, let me erase this as well. The 1-minute charts have validity, and a lot of the strategies that I go ahead and teach can be used for 1-minute trades. The trends in the 20-period moving average, for instance, can be used. But what you have is you have a lot more of this whipsaw kind of stuff where things will trade above and below the moving averages more frequently than, say, like on a 15-minute chart. That said, you can see here as I throw up the 20-period moving average, there are plenty of times where you trade up, you'll pull back, trade up, pull back. So there is validity to the 1-minute chart. But if you look at the size of these moves, unless you're holding it for several minutes, like I would be with my charts, you're only looking on a minute-over-minute basis of half point, sometimes quarter point, sometimes no trade. I mean, sometimes the ticks just don't go anywhere for a minute or two. So you got to ask yourself, what's your profit objective, and what you're looking to take out of the market. Can the indicators be used? Yeah, I prefer like a 5-minute chart will give me a little bit better signals than I'm looking for. However, in the end, I still see more false breakouts on the 1-minute and 5-minute charts than I do on the 15-minute charts. It's a lot harder to take the market in a false direction for 15 minutes or 30 minutes than it is for 1 minute or 5 minutes. Okay, so can the techniques be used on the earlier charts? Yes, but be prepared for more fake outs and whipsaws, so your money management is going to become key there. Todd?
Okay, next question is, I tend to do much better on choppy days, spotting double tops and bottoms, for example, than trending days, and I find it hard to spot when to enter a trend once it has started. Any recommendations?
Well, sure. On a trending day, I understand what you're saying to the viewer who asked that question. When you're in a non-trending day and it's been clearly defined and you just buy the supports, you sell the resistance, for some people, that's a great style, okay? But there's another school of thought for trending days where, what you do on a trending day is if you miss the initial move, don't fret. What you do is you wait for a pullback to like the 20-period moving average, especially the first pullback to a 20-period moving average. more times than not, in my opinion, is very successful. It holds the 20 period. It usually has to hit, when a trend ensues, it usually takes a couple times of the 20 period being tested. In fact, kind of like case in point here, we hit the 20 period, we broke to the 20 period, we hit it here, then we tested it here. You see it, even an overnight trade. It didn't go right through it. It had to horse around and monkey around with it for a little while before the trend actually changed. So what I'm saying is that there's usually opportunity for you if you've missed the initial trend to find a retracement. My favorite retracement spot is the 20 period moving average. If if you're more aggressive, you can just trade pullbacks to my speed lines. But my favorite is where I get a pullback to near my 20 period moving average, usually within half a point or a point of that is where I would start looking at entering a trade if I miss the initial opportunities. Todd?
Okay. Our next question here is, I noticed with your conservative setup that the pullback is going to support resistance, but not necessarily the next one. Sometimes it goes through a couple tight levels only to rebound on the 20 moving average. How do you time your entry in that case? Do you wait to see what the level is to choose to rebound on? So let me read that one more time.
Yeah,
I noticed
that one.
Yeah, it's again, these are emails. I mean, how we all type emails.
Sure,
it's sure. Yeah. So
we all
I
know
noticed,
how I type. We all know how I type anyway. So I
definitely
understand.
That's why you're not allowed to type.
Exactly.
Okay, I noticed with your conservative two-bar setup. I'm going to kind of add a few words here. I noticed with your conservative two-bar setup going through support or resistance, but not necessarily the next one. Sometimes it goes through a couple of tight levels only to rebound, I'm assuming they meant retrace, on the 20 moving average. How do you time your entry in this case, and do you wait to see what the next level is to retrace on? So I think in a roundabout way, they're asking pretty much the same question about entry off the two-bar move. And so I think, this is I think you've answered that quite well, so I think we could probably move to the next one. If someone in the room has asked that question, if they want to clarify it right now, that'd be great. We'll just
absolutely. If somebody asked that, if somebody wrote that question, we completely understand. Like I said, we all know how I type in the chat room, so I completely understand that if we just don't understand the question, feel free to re-ask it, or if you see an example on the chart here, I'll be more than happy to answer it for you. So other than that, let's move on.
Okay.
Sure.
Okay, next one is another time frame question. I need to learn about taking trades from lower time frame charts, like 5-minute, 500 tick, 200 tick. And you kind of touched on that already, but you might want to elaborate.
Yeah, well, okay. I need to learn to trade lower time frame trades. I guess my question would be why? Why do you need to learn to trade lower time frame?
Maybe as a scalp. I don't know if it's his technique or something. Perhaps.
Yeah. Well, it sounds like the person's changing their style is what I guess I'm sensing out of that question. The way it says, I need to learn how to trade lower time frame. I guess maybe I'm reading too much into it. I guess that question.
Or Robert, one other way to think about this. You know how we always look at our longer term charts and whittle down to the smaller time frames to actually enter and exit a trade. So maybe that's what he's referring to, but even a more micro level.
Sure. Well, and to that point, let's discuss that for a minute. For those of you that were in my previous like my indicator webinar, you know that I actually have the monthly charts, I have the daily charts, I have the hourly charts, and both 60 and 120 minute type charts. That I look for very specific things that I kind of taught you on those charts when I showed them to you, and then and then we break down to the 15-minute, which is as low as I go, generally speaking. So for a shorter term time trader, what they would probably, I still believe, just so you understand, even if you're a 1 minute, 5 minute type trader, I still think that you should understand what the macro trends are. Okay, and that's for obvious reasons, because if the monthly, daily, weekly, hourly charts are all on a sell, and then you get my sell signals on your 1 minute or 5 minute charts, what's more likely to happen? It's more likely to be a way nicer move than if the hourly, daily, weekly, monthly are all on buys and you're trying to go ahead and short. It's not as likely to be as fruitful of a trade. So if you're a shorter term time frame trader, a 1 minute, a 500 tick chart trader, 5 minute chart, I strongly encourage you to still marry up the longer term trends with the shorter term trends as much as possible, specifically the next levels up. So like if you're a 1 or 5 minute trader, a 15 minute and 30 minute and or a 60 minute type chart would be ones you'd want to have going in your favor. Okay, you may not need the monthly and the weeklies going in, and even the daily for that matter, going in your direction. Although generally, just so you know, I really prefer people to take trades in the direction of the daily trend. However, that what you really want though, if you're trading in 1 minute, 5 minute charts, look at the 15 minute, look at the 30 minute, 60 minute type charts. If those trends are going your favor, then turn down the microscope or turn up the microscope. Look at your 1 minutes and 5 minutes for my setups and go ahead and execute on those. But at least you have the 15, 30, and 60 type minute charts going in your favor, so you'll get the most bang for your buck out of your trade. Because every time we go into a trade, keep that in mind. Every time we go into a trade, we risk a lot of money, especially for those of you that aren't disciplined yet enough to go ahead and put your stops in appropriately, and you will risk 10 points to make 1 point. So you're risking a lot of money each time you take a trade. So what you need to do is leverage the odds as much in your favor as possible. And by doing so, making the highest probability trade. This is not Vegas. If this was like Vegas, I wouldn't trade. I would just go to Vegas. I actually don't like to gamble personally as an actual gambler, except for a little bit of fun. I'll go to a craps table or something, when I'm in Vegas down here for like at the seminar I'm speaking at next month. But I'm not a gambler. I like probabilities being significantly in my favor. And so for you to get the significance and the probabilities in your favor, you really want those higher time frame charts above you, the next 3 higher levels or so above you, to be in your favor as well. So keep that in mind when you're trading. That's how I'd answer that question. If you're looking to learn how to trade those shorter term time frames, I'd say honor the higher time frame charts first. Todd?
Okay, the next question definitely was just answered a few minutes ago, and I'll just read it for reading's sake, is how do I enter once a trend is underway if I've missed an entry, or if I want to add to a position? And I think you did already discuss that, Mike, but if you want to add to that, that's fine.
Yeah, no, I think we've hit that one to exhaustion.
I
I want to make sure we go ahead and save time for open
Sure.
questions here at the end.
Sure.
For people that have new questions that have come up along. We've been at it for about 2.5 hours approximately. I just want to make sure that in the end that we save time for everybody else. So let's keep going on the question list.
Okay, here's another one you somewhat touched on, and you could probably add just a touch to this. Is can you show an example of a 2-bar, or give an example of a 2-bar breakout that is likely to fail?
A 2-bar breakout that's
likely to fail. There's, I guess, associated with opposite trending moving averages.
Yes.
Or something.
Yeah. Well, no. A 2-bar breakout that's likely to fail is typically one that's gone ahead and exhausted its potential prior to going ahead and moving to the. Here's. Let's see. I mean, as we look at even on the screen here, we've had a couple that really exhausted themselves quickly. This one here, for instance, we really this bar, these two bars here were really not a decisive break, and I think I told people that in the student chat room, if I recall. I didn't feel that this was really a decisive two-bar break. This because, in part, because this bar right here, first of all, this one didn't close above 204, but this one went ahead and was about 50% level. So the two-bar break strategy, ones that are about likely to fail, are ones that go ahead and close about 50% when eyeballing it. Okay, not when you get the ruler out and measure it. But when you eyeball it, does it look like it's anywhere in the 50% level on the bar? This one here, too close to the 50% level. And then the second one, same thing. Both these bars really were well off their highs, almost to the 50% level. Those are the kind of bars that are likely to fail. In fact, right here, you'll see we got the one bar up, and it went ahead and failed. You see here we made another attempt. This is only a one bar, so it's not even the two bar setup. But you see when these things come decisively off their highs, those are the kinds of bar setups that are likely to fail, and that's what I'm trying to to convey to you here. The other one that's likely to fail is when it's gone ahead and moved a significant amount of time, or I'm sorry, a significant amount of space in a very short amount of time. So when you're moving 10 or 15 points or more in a couple of bars, those are the kind of bars that are likely to go ahead and retrace. Now, in the interest of full disclosure, I traded this, okay? This was actually a setup that I traded. We broke, but we had a nice little hook here, and we went ahead, and even though we had a big move down, I actually traded this, and then I got out on this bar right here, okay, just for full disclosure. But at the same time, I would not recommend this for your average trader because of the fact that, I'm concerned you've burnt up so much coming down here. I mean, you think about this. Look at this. This was 1205. By the time you got down to here, you were at 1190. You went 15 points in two bars. So what could happen? You could have a 4, 5, 6 point retracement. So what you have to do there is you have to be prepared. You have to say, okay, the two types of bars that are likely to fail, the two bar setups that are likely to fail, ones that come more than 50% or around 50% off the high, or ones that move too far too fast. And usually, as my rule for that, it's 10 to 15 points in two bars. That's too far too fast generally. Okay, so that kind of answers the question there. But just so you understand, though, that's why I have like the scaling strategy for when we do move too far too fast, because you could throw X number of contracts in here. Remember what I said? Then you'd be prepared to throw your next ones in at my speed lines. And so here, if you threw in even, let's put, say, one contract here, your average is right here, which is at around the 1193 level. It drops all the way down to here, which is around the 1186 area. And you've had plenty of opportunity, even on just two contracts, to go ahead and make, 2, 3, 4 points, but yet you significantly minimize your risk after going ahead and having such a sharp drop, which is why I demonstrated the scaling strategy, a technique that I've used very successfully. So that kind of reiterates the concept and also answers the question here: what are some that are likely to fail? Ones that move too far too fast, ones that go ahead and pull back around 50% off the high, like as you see here, it did, and as you see here, it did. So you had a two-bar break above this resistance level. Well, let me rephrase that. You'd have what people would think is a two-bar break, but this is not Robert's two-bar setup by any means. And any of you that have been here and have listened to this, I hope you all can see that and say that, yep, 50% off the high, 50% off the high. There was not a two-bar break here. So, but how many people thought this was a two-bar break? There was plenty that thought, oh, two-bar break back above 1204, and here's your pullback bar. But hopefully you can all see that was not the case there. And sure enough, then he turned right around, rolled back, and died again. So there you go, Todd.
Okay, great. Next question is, do you have specific setups for scalping, for, like, example, on non-trending days, just to make a few points here and there?
Yes, yes, I do. And what I would say is, basically, I'm trading. Let me get the thing off here. Okay, there we go. what I'm looking for with non-trending days, or just basically days that are slapping around, I'm looking for trades. This is when I'm feeling aggressive. Remember we talked earlier about not trading? In fact, Todd, I think you and I just had a conversation the other day about there was a morning I was not in the zone. Remember that? You were asking me, did I catch that move or whatever? And I said, no, I'm a little slow to start today. I'm not on that initial move. So, when I'm not feeling 100%, I go ahead and I stay out, whether mega move or whether scalping. As far as for scalping, though, what I generally like to do is just identify which way the market is moving on a very short-term basis, because even if we're in a non-trending market, what you'll see here is that, let me see if I can find, well, I guess it really doesn't matter. Any of these days will apply. Uh, if I'll look for trades around my 3 to 5s. Okay, if I'm looking to scalp, I'll look for trades around the 3 to 5s, and that might be the time where I'll go ahead and I'll go down to a 5-minute chart. And so as we're sloshing back and forth, I'll look for pullbacks to the rising 3 to 5 moving averages, or I'll look for pullbacks to a falling 3 to 5 on a 5-minute type chart. That's about when I turn up my microscope for scalping techniques, that's how I'll do something like that. That being said, again, I do not come into each day looking for trades that are scalps. I just want to make sure people understand that. I am not really a scalper by nature. But when I do get aggressive, and there are those days where I do get aggressive and want to turn the microscope up a little bit, and if we're in a non-trending day, if I choose not to sit aside, I'll go ahead and I'll look at a little bit lower time frame, which in this case about the lowest I really go is about the 5-minute chart, just to go ahead and see if I see some pullback opportunities to my 3 to 5 moving average. Todd? Hey, Todd?
Yeah, can you hear me?
Yes.
Okay. The question is, do you ever take an entry between your levels, like a trend following entry?
Yes. And that's, I mean, frankly, that's kind of what it's all about. What we're doing is you're looking for, and let's say a break above, a level, and then you're looking for a pullback, and that pullback should happen right in the middle of the levels, because the whole idea is you go ahead, you pull back then to your rising support, and then you ride the trend to your next level. So I would submit to you that all of my trades are kind of well, most of my trades are with the mindset that I'm going to break a level, pull back, and then look for the ride to the next level off of support, and that's how I do it.
Okay. Next question is a fish hook question. He's basically asking, a pullback on a fish hook to a speed line, would that be a good entry? And I have a follow-up with that, is with fish hooks in general, what's an example or a situation in which a fish hook is likely to fail? So kind of a two-part question.
Okay. Well, first of all, hey, Todd, just so you know, your microphone was really bad on that last time.
I had my hand through my mouth. I'm sorry.
Okay. If anybody wants to type Todd a question and ask him why he had his hand in front of his mouth, you're welcome to it. But as far as the fish hook, absolutely a pullback. Let's go ahead and turn on our little fish hook screener here. A fish hook a fish hook or a bent finger that hits the 20 period, or excuse me, the 3 and 5 periods is actually generally speaking, a fairly higher probability type trade. So, because if you think about this for a minute, if the pullback, or if the fish hook goes ahead and let's say the market's moving up this way, if the fish hook would pull all the way back down to the 20-period moving average, that would actually be too steep. I don't like to see that. As you know, what I like to do based on what you learn is, and here's the bent finger right here, see it? And that pulled right back to my 3 to 5. So actually, the 3 to 5 bent finger uh, or fish hook is actually ideal if it pulls back to the 3 to 5 period moving average. But you see here, what happens, the only time where that would not be the case is, again, if you have too steep of a pullback. And see from here to here, it's kind of too steep. And this answers the second part of the question too. So first of all, in summary, yes, a fish hook or a bent finger to the 3 to 5 generally is a good thing. However, if you have gone ahead and just recently had a fish hook in the opposite trend and you get another fish hook, they can be higher risk. And so what I mean by that is, let me scrape this off here. Okay, this was a good bent finger. It was a rally. It had been rallying for a couple of bars, and it went ahead and made a fish hook, or I'm sorry, bent finger. Went ahead and hit resistance, stopped at resistance, so it was only good for a couple, 2.5 points. Then it started falling, and all of a sudden tried to make another fish hook right there. Now, the thing is, though, there was no trend here. Was there a trend to the downside? Absolutely not. The trend had actually been to the upside. So this fish hook, when are they likely to fail? When their counter trend is when they're likely to fail. What we're really looking for is, if you're going to go ahead and take a fish hook that's going to go ahead and pull back, or a bent finger, you want to, so if you're going to go long, you want the bent finger to go ahead and be giving you a signal to the long side. What you don't want to have happen, let me draw it, is all of a sudden, you've got this move to the upside, and all of a sudden you have like one bar down below, and you're suddenly taking a fish hook right on the other side of a buy fish hook over here. It moves around one time, and then suddenly you're taking a sell fish hook. This is a counter trend trade because the trend has been up. I do not recommend it. I don't suggest it. Here you have the 20 period moving up, so you're in the right direction of the hook, okay, or the bent finger in this case. Here you had a sell side hook, which again, keep in mind, it was very steep. First of all, it was down like this and up like this. Can everybody see that? You know how steep that was. That is not my usual fish hook. When it retraces 50% or more back up, I don't like those kind of fish hooks. I'm looking for that more shallow type fall versus this. And I drew a lot of those last week in the webinar from the setups webinar. So go back, and for those of you that had the webinar, go back and watch that to really ingrain that. So when are they likely to fail? When your fish hook is counter trend. Okay. And Todd?
Yeah. Okay. I have a quick question. How often are you trading off a line chart versus a bar chart? Because I normally see you trading off bar charts, but how often do you look at your actual line chart?
The only reason I have the line chart on is if I see, I've gotten very good. What you got to understand, in fact, I think
you flip back and forth.
Yeah, I've demonstrated this before. I can usually see, I mean, most of the time you can see, when you've trained yourself to do so, I can see the fish hook forming mentally right off of the pattern. I don't have to go ahead. Like here, I see a couple up bars and I see it roll over. I'll bet you that bar right there was a fish hook. Oh, okay, it was the bent finger. Okay, you can kind of see it forming. Okay, mentally. So I don't need to have the X-ray vision turned on, if you will, for the bar chart. But and that's why I mentioned last week to people was I recommended the line chart as you're getting used to or newer to the concept of like the fish hook. So I guess in closing on the question, I only turn the line chart on when I'm not quite sure if something's actually a fish hook or not by looking at it on my candle chart.
Okay, and just a small follow-up to that is when a fish hook is forming, when exactly do you want to enter in that, or do you want to start scaling in? Do you want to wait for the close, or as it's kind of wiggling back and forth and it's looking pretty fishy, if you will, do you want to start scaling in?
Okay. Did that question just get asked?
Yeah, it was Joe. I had to sneak that one in for him.
Joe, what did I say a little bit ago? Wait till the bar closes, because Trust me. In fact, come on, Todd.
You know,
You seen that last week live in the chat room. Fish hooks cannot become fish hooks by the time the bar closes. How many times did
exactly,
you see that? Okay.
exactly.
Joe, hand slap for you. Wait till the bar closes.
And we're getting some comments on that one. Okay, next question here
I hope those comments
is,
were everybody slapping Joe.
no, it's Joe slapping himself, actually.
Oh, good, good, good. Okay.
Probably with a wet fish or something.
That's right. Excellent.
Next question is, how do you use the VIX to decide on entries and exits?
Good question. Okay. First of all, these were open questions. So are we through this section, Todd?
It was a very appropriate question, and I got that question a lot in the chat room this week, so I figured we might as well throw it out there at this time. So
Okay.
it's just a very good time.
I didn't know where we were in the question
No,
cycle. So.
yeah, this is the longest section, so we're kind of about 2/3 of the way through.
Okay. Let's go ahead and let's see. We go ahead and answer the VIX question.
Yeah, okay, so the next question is, how do you use the VIX to decide on entry and exit points?
Okay. Well, what I like to do is with my VIX is I want to go ahead here. Let's do this. Can I move that? There we go. If I'm looking to go ahead and go short the market, I want the VIX to be above my moving averages. I want them to go ahead and, again, give me trend confirmation here. So what you'll see is I want my moving averages, in this case the shorter-term moving averages, such as the 20 and my other short-term moving averages, I want them to be rising, okay? Because remember, when the VIX is going up, the market is likely going down. They're kind of an inverse relationship to each other. So the biggest way that I use the VIX is as a counter trend tool. And sometimes, just like the RSI, and that's why I told you, sometimes the RSI gives me better indicators. So does the VIX with setups too. So I look for a couple things. If I'm looking to go short, I like the VIX to have an RSI above 50. Why? Because that's a stronger trend, and so if the VIX is going up, the market's likely going down. Okay, and conversely, if the VIX is going down and below 50, the market is likely going up. Okay. So that's kind of what I look for there. Is the VIX basically trending the opposite way and has support, moving average type support, and RSI type, support and resistance above or below the 50, on it. That's kind of what I'm looking for there. And if that agrees, then that's one more notch in the belt for me to say, okay, I'm seeing a confluence of indicators on multiple financial instruments and indices that are saying the same thing to me. I'm getting the same message from different markets. And I like the VIX because it is an inverse indicator. So if I'm reading it correctly and it's moving correctly, it will help lead me towards a good signal on the S&P trade. On the other chart, I just want to show you that one real quickly. Same concept. What I'm looking for, and we discussed this a little bit earlier. I believe it was Mike, if I recall, that asked a question earlier about the this chart. So same concept. What I'm looking for is these channels to be rising if I'm looking to short, and these channels to be falling if I'm looking to go long. Okay, those are a couple of the key things that I'm looking for, as it relates to the VIX. Okay, that's about all I look at really for the VIX. I look for them acting the certain way around my indicators. As I showed in the indicator webinar, what the different indicators were and the lengths and everything else and all that. So. Just understand that that's kind of how I'm looking for them. Are they trending the opposite way of what I expect the S&P to be trading? And once I get that confirmation, then that's one more notch in the belt to make the trade with the S&P. Todd?
Okay, this next question, you're really going to have to struggle. You're really going to have to struggle to find an answer for this one, but I bet you can dig deep and find it. You mentioned it's been a while since you've had a loss scaling in. Can you give an example of one of your losses?
Well, actually, I mean, I wish that question would have been asked in advance. I could have perhaps found a trading statement, and actually reviewed that. But yeah, no, I mean, what I think I said was that the losses, as far as the scaling, what happens is usually with the losses. The losses are usually early on, and then what I do is go ahead and add more contracts in near the resistance level to go ahead and compensate for the trade. So let me go back to last week's webinar, because actually I actually demonstrated that in last weekend's webinar. Was the person that asked that question in last week's webinar?
Robert, I really don't know who asked these questions because I consolidated them all from all the different sources.
Oh, okay. Well, because I showed that in last weekend's webinar, how that actually worked out. So I'm trying to right now take us back to that the day of the webinar, see if I can show. I discussed the example of how I'd scaled in. Um, let's see here. I'm trying to remember what I did was, for all of you that are here today, what I did was, I mean, I guess I did it last weekend when I had my actual trading statement up. I showed what happens is, to the point that I made earlier, that sometimes these trades start out as losses. If you're on the right side of the trend, because what happens is you get like the initial two-bar break. So I guess you know what, that's what I'll do. I'll go back to the one here. Give me a second. And where are we? Okay. Like this trade here, I recall specifically that I got into this trade, excuse me, and I was going ahead, and at one point I was losing, and I was going ahead. Of course, I added more contracts in, but as you add some of the contracts in, I added more down in here, and some of those were losing contracts in the scaling, because when it rolled back up, it went ahead and obviously it was above the price where I shorted more. But since some of them were shorted earlier on and at higher levels, the net result of that trade was that I won. That was right. And why did I take it? Well, I was on the right side of the trade here. This is a downtrending moving average. I had my speed lines with me here. So we had the two-bar break and we had the pullback. But what got me into the trade, of course, was the two-bar break. As I told you, I trade a little more aggressively. So I started going and shorting it. But as we were shorting some of it, then it started moving back up. I shorted then a bunch more at the higher level, and so it went ahead, and then as it pulled back down, I went ahead and got out of the trade with a large number of contracts with the profit and made money on the trade. So that's an example, though, of how when you're scaling in, not all of your scaling. And so in last weekend's webinar, I actually showed that. And Todd, you certainly recall that, right? I mean, I know at least you were in the last weekend's webinar.
Yeah.
Okay. So, I showed my actual trading statement, all the actual entries for the trade, that were taken, and how it was actually going against me 2 or 3 points, what I'm looking for, and keep in mind, is that I'm looking to go ahead and short up until a specific point. In this case, it's either the downtrending 20-period moving average or the downtrending speed lines, is where, depending on how confident I'm feeling with the trade, is where this trade's going to come to a screeching halt if I'm wrong. So I'll scale in, and then if I didn't hold it till over here, I'm just letting you know, but if I'll determine my point where I want to get out. In my case, I got out this particular time at the speed line level, not at the 20-period moving average level. But I'll scale in until I feel confident that I've got enough trade and that I've exhausted the potential opportunity for gain off of that trade. So, but not all of the scale-in will be a winner more or less by default unless you happen to get into a trade right here and it just starts falling to the downside. And you just finally say, wow, it fell so much, I'm just going to get out of it. But if you're actually scaling in quote unquote properly, or how it will usually work out, you'll scale in, and then it's going to go against you a little bit up to a falling resistance level in this case, and then it will resume its trend to the downside. But you've added in, and so your average is at a higher average. And as you recall, I repeatedly mentioned that last week, was the key is to be on the right side of the trade, which I mentioned over and over and over again. How do you know that? One of the clearest ways I can demonstrate that is which direction is the 20-period moving average trending. So there you have it. Todd?
Okay. Yes. And the next question, a number of people asked that you pretty much answered, but I'll read it for reading's sake here, is until what point do you keep scaling in and then rethink with a cool head, say to yourself, well, this trade is probably not going to work out for me, and get out at a loss? So
Okay.
you more or less answered.
Yeah, I already answered that. Basically, when it goes against my, the two key things that I'm using for the scale-in strategy for me in particular is this downtrending 20-period moving average, or the downtrending speed lines, and the downtrending 20-period moving average. And if it's basically gone beyond the downtrending 20 moving average and closes above that up in here, as far as I'm concerned, it's a failed trade. It's what I expected to have happen isn't happening. If I'm expecting a trend to continue to the downside and I have a powerful bar above it that closes above my key resistance level that was giving me all my downward momentum, that's just too much risk for me. So something potentially has fundamentally changed, potentially a news announcement, and since news will hit us at least a few seconds generally after the real market, by the time I figure out it's a news-related event, it could go against us several more points. They could have found Osama bin Laden. They could have, signed a peace agreement with Russia, and Russia is going to move away their nuclear missiles subs from our ports. Something to make things go up, or another London bombing attack, as we saw, and or the 9/11 terrorist attacks, and how things can sell off sharply. As a result. Now, of course, 9/11 was pre-market, but you understand what I'm saying. So the point being that by the time we know what caused that big bar to go the opposite way, we may end up having a couple more big bars. So I'm not going to go ahead and second guess what the market's telling me. I expected to have it happen, expected to have it go down, and if it turns around, closes significantly up over my resistance level, I'm gone. Todd?
Okay, now we're going to move on to stops. Stops, when, how much, this person makes a comment. Many in the chat room say they don't use stops, which I don't know who those people are, but they should be, and how to use them. Very important information for most of us, and I concur with that.
Okay. Could you re-ask the question?
So I think the answer to this question would be your explanation of your ratio. How many points you want to get for, like a 3-to-1 ratio or something like that.
Yeah.
Where to place your stops.
So the part about the chat rooms was irrelevant, I guess, because the
comment
was
it was a comment, and it was just a comment he made, and I would like to know who those people are.
Oh, okay. Yeah. Well, I'll say this though. One of the problems I see with chat rooms is, that a lot of these paid chat rooms, what happens is you'll hear these people go ahead and they'll say, okay, you got to have big stops. This is a professional's game, and you got to have big stops. Okay, but then you'll hear sometimes the same people going in and saying, okay, it's never too early to take a profit. It's never too early to take a profit. And it's like, wait a minute, how do you let a trade go against you 5-10 points in these paid chat rooms and then turn around and go ahead and take a 1 or 2 point profit? I don't get that at all. So then to follow up with that and to your point, Todd, I've actually did two little mini free webinars, if you will, on YouTube on stops and that, and I talk about those ratios a little bit. For your average trader, who's having a tough time of it, if your win-loss ratio, if you win more than you lose, you can be more flexible. 1-to-1, stops or losses, things of that nature. But if you're going to go ahead and if you're losing more than you're winning, you probably better not have, 2-point profit targets with 5-10 point losses. So my comment would be that it's very subjective. Stops, a lot of it depends on your win-loss ratio. I can be far more aggressive with my stop placement because my win-loss ratio is higher. And in part, that's because of the scale-in techniques and everything else, so that even when I'm wrong, I can usually bail myself out of trouble. But for your average trader who goes ahead and decides he wants to short after the market's already moved down, 15 points and then gets caught in the retracement, or, same thing over here where you're shorting here, then you get on the wrong side. I mean, there was one trader yesterday who made the comment, I've sold all, or I've sold all the, or I bought all the tops and sold all the bottoms, I think was the trader's comments yesterday. That's a person that probably better have, tops, tight stops if they're not going to go ahead and honor the rules of buying at support and, selling at resistance. So, which is really, kind of more what I try to, methodology I try to teach, more trend trading. And so stops are very subjective to your individual risk tolerance. Some people, they see a 4 or 5 point loss, and I've actually seen people freeze up. They don't know what to do. They're looking at their screen. They're seeing they've lost, depending on the contracts they're trading, X number of hundreds or thousands of dollars, and they're like, oh my God, I can't take that loss. What do I do? So what they do is they sit there and they just hold it. They cancel their stop and they hope to heaven that it's going to come back. And so stops, first of all, my comment about stops is you must honor them. When you put a stop in initially, it's usually with a cool head. When you get very emotional and you want to remove your stops once it starts going against you and you realize, gosh, I'm losing money and I'm about to lose money for real and take that loss if I don't cancel that stop. But you can't cancel your stops. You're not going to be in this business very long if you go canceling your stops. And then the other thing is, as far as the ratio, how much do you let it go? Well, you got to ask yourself, okay, am I a scalper? Am I trading for 2 ticks? Well, if you are you going to let it go 5-6 points against you? So if you're a scalper, no, you're not. How much profit are you seeking on in your average trade will help you determine how many points you should go ahead and risk. And I would strongly encourage everybody here to consult a registered financial representative on that because it's subjective. I'm going to do something different than most of you. It depends on your capitalization. How much money do you have, frankly? Can you afford to let something run against you? I told you I'm hearing some of these horror stories, if you will, about some of these people, and I've got the letters in writing, how these people were with gurus. They were with these, people. They paid them $300, $400 a month. They lost it, and the one guy came to me, and he was down to his last $3,000. His last $3,000. Now, are you going to go ahead and start taking 5-point stop losses on $3,000? Your broker is going to call you and say you're done pretty darn quickly if you are. So a lot of it's how capitalized are you, how successful is your win-loss ratio. Those are some key factors that you need to keep in mind. And also, can you afford to implement the scale-in strategy that I have been discussing? Because that will obviously dramatically skew the results, because even though you're wrong initially on some of your initial entry, by the time the trade's over, you can be very right on the trade as you scale in, as long as you're on the right side of the overall direction, as we talked about. If you're shorting in this direction and you're buying in this direction, you're on the right side of the trade. So even if you short here and it goes back up against you a little bit, and then you sell your next ones off at the falling resistance, you're on the right side of the trade. But if you're buying right here because you think it's starting to break back out above this downtrending 20-period moving average, well, you better not be buying more here because you're on the wrong side of the trade. So it all depends on those key factors, and I can't emphasize that enough. There is no magic bullet. There's these general guidelines kind of that I outlaid in my previous free YouTube videos, and we can get you the dates on those if anybody's wondering, if you haven't already seen them. But as far as, in the real world of trading, though, it's very individual. Stops are very individual, but stops are an absolute necessity. To go ahead and trade in these markets, especially the volatile markets that we have, when we're constantly at risk for terrorist attacks, government economic news, and which way the wind's blowing for any given day of the week, which country is causing an uproar for us again, it doesn't matter where you are. If you're in Europe or anywhere else, if you're trading the American markets, you're affected by what other countries are doing, with the American economy and such. So, your stop is in when your stop is in. You going ahead though and reacting to a news announcement, you'll never get out of a news announcement as quickly as your stop will get you out. So at least with your stop, you got your finite risk. You know what your risk is, and so for anybody to sit there and tell you don't use stops, that's madness. And I can't emphasize that enough. It's absolute madness not to have a stop. So, Todd?
Okay, another question is, and it's kind of an interesting question, it's said that, or is it true, that stops are generally hit because of bad entry. Do you agree with that?
Yes, I do agree with that. I do agree with that. And the reason why I agree with that is because what happens is, in fact, as I recall, I'm the person who said that. I'm the person who said that on my YouTube video several months ago, and I noticed that people have been saying that since then. So I hope that's something you learned from me. But absolutely, what happens is, and this goes right back to the whole thing we were talking about the gentleman who came into the chat room yesterday and said, I've bought all the tops and sold all the bottoms. What happens with these entries is that you've got this whole downtrending market here, right? So what happens is then all of a sudden it's going ahead and trading sideways, and then it starts to make a mad rush down. Let's be honest about it, okay? How many of you, you know what? I want to raise the hands this time, please. I want everybody to be honest with me here. How many times have you gone ahead and watched a move in the direction of the trade, 5, 10, 15 points, and then you went ahead, you did nothing all along that way, and then all of a sudden you had the mad rush down, one final big blow-off bar, and you got sucked into that because you said, I'm not going to miss anymore, I got to get in, and you just, something in your mind said, I've got to go ahead and get into that trade. How many of you have done that? Okay. Yep. Exactly. That's what I thought. Because you know what? I've done it. All right. And I just know that if I've done it, that probably means the majority of you, if you're trading real money, have done it too. It's a natural human reaction to go ahead and be sucked into a move like that. Now, let's talk about that for a minute. So what this means is that you've gone ahead and you missed the majority of the move. All of a sudden you get sucked into a blow-off bar, okay? Well, here's the beauty of that. Normally, I'm able to keep myself out of trouble as a rule because what happens is when I get sucked into the blow-off bar, I go ahead and if I put, let's say, a couple contracts in there, and then it starts to rally back up. Well, what happens with the blow-off bar? It usually reverses back against you, and then makes another run back down again for all the people that didn't get sucked into the blow-off bar the first time. So with my scale-in strategies, as it scales back in to the falling resistance till the time, even though it's a blow-off bar, I'm usually able to go and get enough contracts in here, and then when it falls back down for the second run, I can get out and either scratch or make a small profit. But in the real world, the average trader is going to do this. They're going to go ahead and they're going to throw all their money into this right here, down in this area somewhere, whatever contract size they trade, okay? They're not scaling in, okay? They're going ahead and just dumping it in. They're like, sell the boat, market order, and you're getting filled right down in this area, and look what happens. So now you're filled down here in the 1185 area. This market goes up. You better have darn well had only a couple point stop, and the market goes up. Well, by the time it's gone back up to here, it's moved against you 3 or 4 points already. So you're stopped out. So what I'm saying is that, entries, it will go ahead and, in fact, you know what? Let me give you another example here, which was a real world example from yesterday. Not for me, but Todd, I think you just mentioned this a little bit ago. This market started to reverse to go to the upside. The 20-period moving average was rising to the upside, okay? But if you bought here, you were buying right at a resistance level, and you were buying, over like 7, 8 points away from the rising support. So if you went ahead and did this, you bought at resistance, bought away from the support, what's going to happen? You go in all in with all your size, you're going to get stopped out. You better have. If you got 8-point stops, you're not going to be, probably around long enough to attend one of my next webinars. So, what I would say is poor entry. You go ahead and you take an entry after it's moved several points away from your rising 20-period moving average, giving you no support. You got nothing but air in here. And you're buying at the resistance level because it looks enticing. After we've been trading up for several bars, we look like we're breaking the resistance, which, as you guys know, I told you this was not a break of the resistance yesterday at this point yet. And yet you buy into this because it looks very enticing. Sure enough, pulls back down, you get stopped out. So was the trade bad, or was your entry bad? Well, the entry was bad because the overall trend, the trend was right. The trend to the upside was correct. Your assessment there was correct. But your entry was wrong because you did it 8 points away from a support level, and you bought into a resistance level. So what's the right trade? The proper entry is to wait for a pullback to a support level and well away from a resistance level. Hence the 20-period moving average here. So the entry was bad. Not your assessment of the overall trend. So do I think that people most of the time get stopped out because of poor entries? Yes. They get sucked into an emotional response. I mean, that's what these markets do all the time. The markets go through one of my support or resistance levels, one bar, and then they turn around and reverse. Guys, all you got to do is look to my chart right here. How many times do you see it? Right here yesterday, even with the mega rally into the close, you had people, you went just slightly through. Look at that. As you know, my top level there was 17 to 20 resistance level yesterday. We traded a couple ticks above that, and then it turns around and drops right away over 5 points. Okay? Here, same thing, over and over. One bar thrust throughs, like it's going through my level, only to turn around and fall again. So hence that's why my support or my breakout strategies are so important for the average trader, because of the fact that you're far more probable, your probabilities are far more in your favor if you wait for the 2-bar break than the 1-bar, because there's too many fake outs. These are the fake outs that people with those needs to make money get sucked into. Oh, I missed this. I missed this. I missed this. I'm not doing this again. I'm not missing this. This is breaking 1220. I'm not going to wait for this. I'm in this trade. You go into the trade, you turn around, it drops against you 5 points, you're stopped out, and then the worst, of course, of all worlds is you get right back in and do it again, because like, okay, I was wrong here, but now I'm right, and it turns around and does it to you again. And I know that's happened to probably the majority of you if you've been trading for any length of time here. It's a natural human reaction. I've done it in the past too. But you got to learn from those mistakes. You got to develop discipline to take the trades closer. And will you miss trades because of that? Yeah. Will there be the times where it just goes right through this, that it truly just breaks through this bar and keeps going up, up, up? Yes, there will be those times. But is it worth it to try to get sucked into all these fake outs only to go ahead and lose a bunch of money for the one time or for the few times where it'll just keep going and going rather than waiting for a pullback? I submit to you, and you guys have developed a sense for my style. I'm very patient in the chat room there. I spend more time telling you guys where not to trade than I tell you where to trade, because I think that's very important to your learning and your growth. So yeah, keep that in mind, that poor entries are going to go ahead and lead to stops. Todd?
Okay, that was a very nice answer. Next question is, how much profit before you move your stop to break even?
Well, okay, you know what? That's subjective. Let's go ahead and let's look at it this way. Where's my next resistance level? Okay, guys, that's what you got to ask yourself. I've taught this in the YouTube videos, and it's the same thing I'm going to go ahead and say here. If we broke a support level here, and we pull a resistance level, and we pull back to support, and I start entering here, I see the next resistance levels up here. I might let it run 5 or 6 points before taking profit, and then moving the rest to break even. If I've gone ahead and gone long right here, somewhere in this area, okay, let's say I consider this a 2-bar break. More importantly, this was actually a broken finger, so I take the trade at the close of this bar right here. The support level or the resistance level this time is only 2.5, 3 points away. So I'm looking, where is my next support? Where is my next resistance level in relation to my trade? And then the rest of it will get moved up to break even. Use that as your guide. Todd?
Okay. Next question is, how do you determine where to place stops at the last resistance, 2 candles behind? Those are like examples, I guess. So yeah, that kind of, you already answered that. It's just being asked a slightly different way.
Okay.
I think they're looking for physical barriers or to place them behind, like MAs or broken resistance levels.
Well, okay. Well, we talked about physical barriers as far as like the moving averages. If it breaks it, I mean, there again, I'm looking usually at the close of that bar, so that bar may close 1 point or 2 points above that bar. That the bar is going to determine that. What's key there is to note I think what people are looking for, if I'm reading that or hearing that question correctly, is you short here. How far above this bar, maybe or so, do you let it go before you get out? I think is what I'm hearing being looked for.
Yeah, that's my understanding too. Is basically using a support line or a resistance line to a barrier.
Well, but there again, we just and so we kind of answer that because here's a case in point where if you shorted down here, you turn right around, had the mega rally, and it closed above the bar. So my rule is, okay, if it closes above the bar that were the moving average that was lending all the support or resistance. In this case, the 20 period had been lending resistance. Okay, you can see that here. It's been lending resistance. You short and you get a mega bar that closes back above it, you get out at the close of that bar. Okay, if the bar rallies up sharply and then turns right back around and closes down here, that's actually a good thing for you. Shows that much more opportunity for potential selling, kind of like right here actually. Okay, see that? Look at this bar right here. How this market was converting to a downtrend, made it look like it was going up, closed right back down, and that led to the mega selling. Okay, so a bar that goes above your level only to turn right back down below is actually a great sell signal in this case. But the rule I use there is, if we're looking for the hard and fast, is that one bar close after a strong move in the opposite direction and a close above, in this case, the resistance level. Todd?
Yes. Next question is, how do you decide on your exits when an exit support is hit using trailing stops, velocity, momentum? I think you've already touched on that.
We talked about that. Yeah, I'm going ahead and looking at where my next resistance level. If I bought, I'm looking where's the next resistance. As far as momentum, I do look for, is the market getting tired? Is there a possible divergence? Here you made a higher high in the market on this 15-minute chart, but yet you made a lower high or equal high here. So this is actually a negative divergence, okay? And what did you do? You pull back from the 1211, 1212 area all the way down below 1200. You moved back 11 points from that negative divergence. That's nothing to sneeze at. So I do look for the markets getting tired off of these indicators, but the primary thing I'm looking for is for my target, where's the resistance if I'm long, and then, okay, where was my entry to move up the rest of it to break even? So we've kind of discussed that. How many questions do we have left there, Todd?
We have not too many in this section. We have about 4 more questions in this section, so we're almost done. But this is the biggest section, so.
How many are in the last section? I noticed we're already almost 3.5 hours.
The last section only has 3. The last section only has 3 questions.
Okay, so let's get through these last 7 questions, and I want to open it up still for a few minutes for some questions from our gang here.
Okay, another stop question. Are your stops programmed to take you out at the bar close? If so, how? And then if not, do you just play stops behind resistance points along these lines? How do you avoid fake outs and piercings and whatnot? So you kind of touch on that. I think that's an interesting one about the programming on a close. But
no, my stops. No, my stops are not programmed. They're just put at a specific level. I don't have any sort of automated order entry like through TradeStation or something that puts an order in or out based on a certain condition. I manually, place that order where I want it for what I want it to do.
Yeah, and I don't really know if you can actually do a program close on a bar, but
I think you probably can through TradeStation. For years,
yeah.
I used TradeStation, just so everybody understands. I used TradeStation back in the 90s. But back in the late 90s, they went, most of you recall, they kind of went to this whole brokerage thing of theirs where they created their own brokerage, and then they didn't want you using their platform and services and everything anymore unless you traded through them. And once they kind of did that, I moved away from TradeStation. TradeStation's got a good product, but eSignal then just at the time and the flexibility that I needed and everything else, and I'd already gone through years of evolution of TradeStation. I switched to eSignal, been happy with them ever since. And I actually used eSignal actually in the mid-90s too, back as data broadcasting for like part of the data feed, and I used TradeStation for my charts. So I'd actually had a lot of experience with data broadcasting / eSignal and stuff. So eSignal became eSignal obviously more recent than that. But so just so but yeah, TradeStation does have some great automated features. You can program your indicators in there, and then it will buy based on that indication, buy on close, I think, and different stuff like that. So yeah, I mean, if you got that kind of thing and you want to use that, you can. But for what I do, and I trade a lot of contracts, I'm able to do it just fine manually.
Okay, another question here is, have you ever had a problem with slippage on the ES?
Yes. Yes and no. Typically, no. The E-mini is a pretty liquid product, okay? But you guys got to understand, I'm slapping around some huge size. So there are times where I go ahead and want to get taken in or out of a market. Yeah, I'm going to clear out a level or two. I mean, that's just a brutal honesty about it. But for your average trader, and I believe the average S&P futures trader in our room came out to like 6 or 7 contracts. Some traded more, some traded less, but the average S&P contract trader in our group was about 6 contracts. Nah, you don't have to worry about slippage, in my opinion. Trading those size. You go dumping a market order in there with the kind of size I trade. Yeah, you're going to have some slippage issues at times. But even then, generally, there's usually on the S&P, 300 to 500 plus contracts on each side. So it's normally not a problem even for me. But there are times where it is a problem. But for you guys, for the average trader, no. I think the S&Ps, are a great trading vehicle. I love them to death. I speak very well of them. I've been with them for years. I traded the Dow futures. I've traded stocks. In the 90s, all through the 90s was mostly stocks. I started trading the Dow futures in the late 90s, and then the S&Ps because I needed more liquidity. I kept having to call down to the pit all the time in the late 90s to get my fills for the Dow futures because of the size I traded, and it was too much hassle. So, and the S&Ps just were well liquid, and so I actually went to the S&Ps for a lack of slippage. So my final answer to you is no. I believe there are cases where slippage will happen, but net over the long term, I think the S&Ps are a fantastic trading vehicle. Todd?
Great. The next question is, I would like to recognize the times it would be least risky to trade 2 contracts instead of 1 or 10 versus 5, depending on account size. So I guess what they're asking is there better times, higher probabilities to trade, 2 versus 10, size and whatnot?
Well, yeah, I guess if I'm hearing this question correctly, there are countless times when you should go ahead and minimize size, in my opinion. In fact, whoever's asking that question, I would encourage you, go back and look every day in my morning commentary. I actually specifically say that. I say, I'm looking for a breakout of this level, breakout of that level. Any trades between these two levels will likely be smaller in size and smaller in time duration. So when I'm in a congestion zone and I'm sitting there twiddling my thumbs waiting for the big breakout, if I do decide to go ahead and trade, I mean, if I'm sitting there, trading around the 1195 level, waiting for a breakdown to 1182 or up to, if I'm looking for a big move above 1204, if I'm just slopping around in here, you can bet I'm not going to be dumping 200 contracts in right here in this whipsaw area. So, what I'd say is that, yeah, the biggest area, if the other is the biggest area where I'm going ahead and struggling with size trades is going to be in areas of congestion. Those are areas I'm not going to want to trade size because you're going to whip up, whip down, whip up, whip down. At the same time, another reason you would not want to trade heavy size is the strategies we've talked about here. If you're looking for a 2-bar decisive break, and this bar actually looks like it's more like 50% off the high, but you're feeling pretty aggressive because of what you're seeing here, if you're feeling aggressive, by its nature, if you're feeling aggressive, probably might want to look at reducing your size. Consult your individual risk trading plan and your financial representative. But I'll tell you this, whenever I start trading aggressively, I back off on size. Okay? So ask yourself, is this a high-risk play? Is this a perfect setup? Is this actually, Robert's, 2-bar break to the upside, a nice pullback to support? Okay, well, if it's actually just a 2-bar break and you're deciding to go in at this bar instead of going to wait to see if you get the pullback to support, that might be a time you might want to do 2 contracts instead of 10 contracts. Okay, so keep that in mind. If you're looking to trade aggressively and you're not waiting for the safe, quote unquote, safe setups, where the probabilities are more in your favor, then you should look at reducing your size. It's not worth it to dump 10 contracts in there, and that's all your bullets then. Remember now, you go in there and that's 10 contracts. It pulls back. What are you going to do? You got no more bullets to buy back here. You better hope it comes all the way back up here just to break even. That's why I like the scale-in strategy. You put a couple contracts in here, then as it comes down, you put in the rest, and so your basis is lowered. You're on the right side of the trade because the 20-period moving average is rising. You're on the right side of the trade, and then it resumes in your direction, but you're making money quicker then because you're not having to wait for it to get all the way back up here to go ahead and be to break even. You're already breaking even down here, so as you get back up to this level, you're in the money. Todd?
All right. Well, that actually ends our questions, the written questions. So if we want to...
there was three more on the other section, right?
Yeah, you want to just blow through
Yeah,
those?
let's blow through those,
Okay.
and then we'll just open it up for Q&A. I mean, we're about
No problem.
3.5 hours here so far, so let's just go through them.
Okay. Okay, these are just kind of miscellaneous type questions. Psychology and overtrading. How do you control that?
Okay. It's a loaded question. I could probably do a whole webinar. I could do a webinar on that. And maybe that's what people need because I mean, Todd, how many times in the channel have I gone ahead and been trying to calm people down and say, maybe I'm going to step away. I talk about waiting. I see people getting impatient in the room because they want to buy or sell a moving average. So I put the comments in there. Well, I think we should wait till we decisively break above this level or below that level. I see people constantly wanting to just get in there and buy or sell. And you got to look at your own motives. And what I'll say is this kind of is an offshoot of what I said earlier, which is if you're over trading, you're trading for the wrong reasons. Are you taking that trade because it's the right setup, or are you taking it because you're a junkie and an addict and you want that next thrill to go ahead and see if you're going to make money, or even the sensation of losing money? That adrenaline rush, you're an adrenaline junkie. And so you got to ask yourself that. Is everything in alignment? Am I taking this trade for the right reason? Or am I taking this trade because I'm going to show my husband or wife, they don't think I can trade just because I lost a couple $1,000s earlier today? Well, skip them. I'm going to go ahead and make that all back and more. I'll show them. Well, like I said, I kind of talked about how the end result of that usually turns out. So you got to ask yourself, are you taking this before you pull the trigger? And I do that myself, by the way, okay, just so you understand. Before I hit the trigger, I look at my screen one more time, okay? I go ahead. I'm going to actually show you what I do here. I go ahead and I actually look at the screen one more time with everything up, and I say, and I kind of do a systems check across the board. I kind of just like how when you cross the street, you look left, you look right. I look at my board one more time. Am I taking this trade for the right reason, or am I taking it because I'm getting sucked into the emotion of a fast move? Okay, and sometimes taking that extra second or two goes ahead and helps me see something that I wanted to go ahead and see to keep me out of a bad trade. So, that's, I mean, like I said, I can really do a whole webinar on this. So to keep this short for today, ask yourself, what is your motivation for taking that trade? And if you're honest with yourself, you'll come up with the answer very quickly. Well, look, just pull back to my rising 20-period moving average. I'm going to play the support. Okay, great. Well, that's maybe a valid reason. Got your RSIs above your 50. You got your ADX positive DMI trading higher. You've got your VIX trading down. It's falling below the 50. All systems go. I'm going long. No problem. But you trade this to the short side here. Wait a minute here. I've got the overall VIX trading down. I've got the rising 20-period moving average. I'm at a support level. RSI is above 50. Gee, should I really be trading this short? Okay. See what I'm saying? Or am I just like, ooh, I want to get into that move? Because I in the chat room yesterday, I saw a bunch of people posting comments. I expect a big sell-off at the end of the day. Okay, so for a person like that who saw that, that would be a great adrenaline junkie move then to try to get into. So just make sure you're taking the trade for the right reason. I've taken trades for the wrong reasons, and so I'm trying to help you go ahead and avoid the same mistake. Um, and if you're trading because you need to make money to prove to a spouse or a loved one or whatever that you can do this, uh, that's the wrong reason. So look at your psychology, look at your motivation. What is making you want to hit the trade right now? Answer that question honestly, and if it's because of a setup, then you're probably doing the right thing. Even if the trade goes against you, it doesn't work out, but at least you took the trade for the right reasons. If you're doing it for any other reason, just you know, release the button and walk away. And that's what I physically do. I walk away because, if I sit in front of the screen, I'm more likely to go ahead and just talk myself into doing the trade. Whereas if I walk away from it and get myself distracted with something else for a few minutes, that passion, that adrenaline rush to hit the button for that kind of goes away. So that's how I handle the psychology and walking away from bad trade opportunities. Todd?
Okay, great. And actually, the second question in this section you just answered, so we'll move to the last question, which I think is kind of a nice ending question. And I believe it was our good friend from the UK, Joe, that gave us this one. But thinking back on your worst and best days that you can recall, what sticks in your mind? So I guess little pearls.
Wow.
Very open question.
Yeah. Gosh. Well, the thing that sticks in my mind for my best trades were that I followed all the rules. Um, I traded with the trend. I added size judiciously. I didn't walk away with a baby profit because I went ahead and, I'm so used to losing that I needed to make whatever profit I could lock in. And I just remember feeling the overall satisfaction of I took those trades for the right reasons and let them run. Um, and it's a huge satisfaction when and then I've gotten better at doing that too from those experiences, is when I've gone ahead and let the winner run, move the stop up to zero, so you know that everything from there is basically a profit or break even. You're going ahead and you're exiting part of the trade, and then let it move it to zero. What a great feeling! It's like an insurance policy. It's like I can't lose. You know what I'm saying? And to go through that experience, identify the right trade, and to go ahead and let it run, lock in some profits, and then move the rest to zero and step aside and say, I'm going to let the trade work its magic unless it hits this key level here, then I'll get out the whole thing. And to successfully go through that process is the best day and the best feeling that you can possibly have. You just have such a big S on your chest. You're such a Superman. Tarzan. You're the king of the hill. The worst day would be when everything had gone wrong. I'll never forget that. The broker didn't follow my instructions. I went ahead and took the trade at the wrong time. This was actually back in the late '90s. Was the one I'm thinking of too. In fact, it was the terrorist. It was the domestic terrorist thing we had back in the '90s. The Olympic Park bombing thing, and I remember that day. And so the worst experience was getting in late. The move had already happened. The stock was up like $15 at that point, I believe it was. Um, and that's when I decided to buy, being the boy genius I was on that particular trade. And the thing went ahead and moved significantly back down. And I had actually put in orders to get rid of the trade, and my broker didn't follow the instructions properly. I didn't follow up on the trade properly to make sure they did it right. Anyways, the thing ended up trading all the way back down to like $6 or something that day, whatever it was. Um, and I just remember thinking, wow, what an idiot. I shouldn't have been in it. My brokers should have done what they were supposed to do, et cetera, et cetera. And it was just, it was one of those times because the reason why it was so bad and it was so many years ago is I knew I should, I'd already been trading for a long time. So, I knew I shouldn't have done it. And that's why I say when I talk to you guys about my experiences, I've been there in 15 plus years. Believe me, I've seen it all. Um, and so I think that, what I learned from those experiences, though, was more conservative, a more conservative nature. In fact, you hear me talk about that then. Oh, we've moved 10 or 15 points. Well, that's too much for a conservative entry. But if you want to be aggressive, you can throw in, and of course, really back up, I went all in on that trade. It was like a bomb detection stock, which after the bombing, all those, went up significantly. And I went in all on that trade. So as it dropped back down to, the single digits, I didn't have any money left to go ahead and scale into the trade as it rallied right back up again, where I could have broken even with a scratch. I fired all my bullets off way up above, $15 earlier. So I've learned from those kind of things over the years, and that's why I'm sharing with you then the techniques that I found that have helped me the most because, like the scaling strategy, when you're trading aggressively, be prepared to scale and take the trade for the right reason in the right direction of the trend. That stock had no trend. It basically jumped up $15 because of an overnight event. It had been trading sideways for months before that. So I learned a lot from my best trades, and I've learned a lot from my worst trades on how to be a better trader and student of the market. So, and in turn, that's why then I've tried to share, the techniques that I've taught you in my YouTube videos, that I've taught in these 3 webinars now. I'm trying to teach you the stuff now that from my learning experiences and how I've tweaked things over the many years to get it right, do it better. And that's what, and so that best day and that worst day were all instrumental in going ahead and developing me as the trader you see today, and that's helped me help you. So, Todd, with that, I guess I'll close on the formal questions and try to answer a few more. Maybe you can kind of pick and choose. We've been going for, I think, about 3 hours and 45 minutes here. Which congratulations, guys! You guys,
Oh, the winners.
Yeah, the first webinar I think went 3 hours, 10 or 15 minutes. Second one went 3.5 hours. For a 2-hour webinar, we're now 3 hours and 45 minutes. So, I hope that if everybody can raise their hands real quick before we get into the open Q&A one last time. I hope that this has been of great value to all of you today, and that now we're wrapping up some of your questions here in a few minutes. That this has been a good experience for you. Could everybody raise your hands or comment if you would, real quick, please? Todd, maybe you can tell me how that's working out for everybody.
They're just gushing with compliments. Absolutely fantastic. And all that great stuff. So.
Great. Well, thanks, everybody. And with that said,
Robert, do you want to take just a few minutes break on your voice there? Maybe get a drink of water. And, everybody can take a real quick break, potty break or something.
I'll tell you what. Let's just that's fine. Let's just. What time is it here?
It's about 1:45.
Okay, let's just take, if everybody doesn't mind, let's just take like a 2-minute break here real quick. I'm just going to drink some water and eat some throat lozenges real quick, and you guys can take a quick bio break or whatever, and let's get back in about 2 minutes here because I want to get to some of these questions for people. Okay?
Sitting down. All right. Craig has a question. Do you give any weight to outside bars, inside bars, and hammer bars?
Sure, absolutely. Let me go ahead and just pull up the outside bars. First of all, outside bars typically then are key reversals up or down, uh, and you'll recall that I'm a pretty big fan of key reversals up and key reversals down. So, and as far as inside bars, I do use inside bars to a degree on more of a macro level, like on a daily chart or so, versus intraday. Intraday, I just got too much going on to be going ahead and like counting every bar and say, okay, that one's an inside one, that one's not. And actually, everybody can see my screen, right, Todd? You can see my screen?
Yeah.
Okay, great. So I'm not looking so much. What I am looking though for is, yeah, if we get an outside bar, generally, especially where it becomes like a key reversal up, or doji stars. If we get a series of dojis, now this was overnight trade, so you're going to see that a lot. But if this is in the middle of the day where I see several doji stars simultaneously, that's going to go ahead and ring a bell with me. As far as outside days, or outside bars, here we kind of had one. It was a huge key reversal down, but then this one was a huge key reversal up, but that was at the close of the day. So as you guys know, I don't really you normally see me saying goodbye to everybody, several minutes before the close because I don't trade. That last 15 minutes and really the last 30 minutes. I mean, it's just so much goofiness that happens with positioning and jockeying and closing out positions of the day. It's pretty much too much Vegas for me. So, but I do look for this in the middle of the trading day. However, right here's a classic case in point. Right here, this is an outside bar, key reversal up. So I'm looking for those on a daily basis. I do look for doji stars that happen at support or resistance level, but I'm more prone to honor them, look at them, and give them weight on higher time frames. Again, daily charts and higher, particularly daily charts. Doji stars, outside days, and inside days mean a lot to me on the daily chart in particular. Craig, Todd.
Okay, Wayne has a question. For money management, how much capital do you trade? Oh, this is kind of a personal question. How much capital do you trade for a living, or or what I would say, what percent do you return per month? So those are kind of personal questions, but I guess
Yeah, those are
on a
personal
basis.
questions. So what I'd say to you is you have to go ahead and usually this question comes out in the form of how much capital do you go ahead and risk on any particular trade. So excuse me. That actually came out, I think, in the last two webinars, if I recall correctly, as well. And it's a standard question, and makes sense. As far as risking on a trade, my risk trading size varies. In fact, Wayne, I think you were at my webinar last week, if I recall correctly. I think it's Wayne Shu, if I recall correctly there. And, I go ahead and you saw some of my trades. Well, part of that was just because they worked out so well, they worked so fast, I couldn't get much size off. I mean, some of my trades were 10, 20, 30 contracts. Then, and even though that was a slow day, you saw my maximum trade that particular day was 85 contracts. That was on the day last week. Originally, everybody, for those of you that are wondering that weren't at the webinar, last Saturday, Friday was a day where I didn't even think I was going to trade at all. But then later in the day, so in my morning commentary, I was not fond of trading at all. But then as the day went on, I warmed up to some opportunities that I saw coming in. So, but some of those opportunities, by the time I started entering, 10 or 20 contracts, it happened so fast, I ended up going in and getting my profit right away. But then there were some other ones where I was able to work more size into it and got about 85 contracts, 85 or 86, contracts was the maximum one I did that day. But the point being that the size varies. It varies based on risk. So you can't really say risk 1% of your capital, 2% of your capital. What my comment was, though, in last week's video, as I recall, was, you need to go ahead and, as a junior trader, and wait, I'm not saying you're a junior trader, but I'm saying to this question in general, yeah, risking no more than 1 or 2% of your capital on as a junior trader in particular. I feel pretty convicted about that too, because as a new trader, you're likely to make a lot of mistakes. Well, you know, if you keep going ahead and losing a percent, a percent, a percent, a percent, it's going to add up quickly. So, going smaller size, and also your psychology. Here's what you got to ask yourself about risk. As your risk goes up, your decisions get stupider. Okay, and there's not a single person here who can tell me that as they risk more money, they don't sometimes go ahead and get more nervous, more stressed, more concerned about, oh boy, look at all that money I'm making, that's awesome, or look at how much I'm losing. The numbers get bigger as you get more size. You should see the numbers I'm throwing around. Sometimes I'm like, wow, that's wild, and so the point being that your psychology is going to change as you get riskier and you get more size on, and as you trade more in relation to your overall. If you only have $100 and you risk all $100 on one trade, well, you can only imagine the kind of decision you're going to make on that trade. Versus if you have $100 and you risk 25 cents, your head's going to be so clear because it's like, well, I don't really care what happens. It's not a lot of money either way. So it just allows you to sit back, look at the chart, and analyze it for what it is, and make a much smarter decision. Versus you trade heavy size, and then all of a sudden, as opposed to your capital, and then all of a sudden it goes ahead and it's moving against you, and suddenly you're finding that you're losing 2%. 5%, 10% of your portfolio. And then you start saying, it's got to come back. I can't lose that much money. You tell yourself that, and you say, I'm not allowed to lose that much money. I don't have that to lose. My wife is going to kill me. My husband's going to kill me. That was supposed to be money for our trip, and I just lost it. So, keep that in mind. And so that 1%, 2%, as a follow-up to our previous conversations on this topic from the other webinars, yeah, I wouldn't be risking a lot. And again, consult your registered financial representative. Futures trading is risky, and because it's risky, you need to make sure you're trading risk capital. And if you're trading risk capital, it's truly risk capital. And I know, I've heard these horror stories from some people, so I know some people aren't just trading risk capital. But if you are trading risk capital, you're going to make, in my opinion, much better decisions in the market because you have more of that deliberate indifference and that nonchalant attitude, freeing your mind to make better decisions. Todd?
Okay, great. Lisa looks to be a world traveler as you are, and would like to know what countries that you trade with your laptop you get the best broadband reception.
Well, I've been pretty fortunate with the countries that I've gone to of late. Hong Kong, Amsterdam. Now, it's funny about that because, as you guys know, I'm actually going to Amsterdam here in 2 weeks. In fact, this time, 2 weeks from now, I won't be here. And so Amsterdam, the hotels there, they all claim to have broadband, but in reality, that's not so true. Some of the hotels I've stayed at, they have one wireless box down there, like the one hotel, the Gestorkel. It's got one wireless box downstairs where the registrar is, and so like when I was on the 4th floor, I got intermittent service. So you got to request to be closer to like the 2nd floor there. So it's really it's kind of intermittent. It's really, but what you got to make sure is if you are traveling to different countries to trade, it's a good question. You need to understand the reliability because reliability is a factor in other countries. Here in the United States, we take for granted the internet that we have. Now, with that being said, as Todd knows, I had Comcast cable out here last night at 6 o'clock, 7 o'clock, Todd, because they had to go ahead and replace
Yeah.
a part. So it's funny we're talking
And how
about
is
this.
Edgar doing, by the way?
Yeah, exactly. The guy who was out here last night, Edgar, was sitting here feverishly trying to get me up. I said, dude, I got webinars, this weekend, and these people are counting on me to be there. So, needless to say, he ended up staying here until like 7:30 last night, getting it right. But that being said, historically, in the United States, we're blessed with some pretty reliable, internet. However, in other countries, you're not. So you need to understand. I would strongly suggest you go ahead and like do surveys or what do you call it, the uh, people's responses. They put in their comments and remarks about different hotels. It's good to read about those different hotels because they it's a selling point. They claim high-speed broadband and they don't actually have it. That being said, Germany has been very good to me, except down in the mountains of Germany. That was not so good, down near the German-Austrian-Swiss border. But, most of the big cities are fairly reliable in most of the Western European countries. The United Kingdom, Germany, and the Netherlands, Switzerland, so on and so forth.
All right. Craig has a question. Do you give any weight to the speed lines crossing the 20 EMA and first pullback to the 20 EMA?
Absolutely, Craig. In fact, actually, earlier in this presentation, I did actually specifically mention that the 3 and the 5 period, EMAs, one of the things I key off of is how they are. Remember, I mentioned earlier I was looking for the crossover. As I said, have the 3 and the 5s come down below, in this case, the 20 period, or have they come across? And as far as the first pullback, I actually spoke about that too, to the 20 period EMA. First pullback to the 20 period EMA after a breakthrough or breakout is probably, in my opinion, one of the highest probability trades you can make. So let me get my little highlighter here. So here, you've been trading down below and you get the breakout above and it pulls back, and that pullback, and the second and the third one can be very profitable. Don't misunderstand me. But the first pullback, and I think I actually heard you use the word first through Todd there, is generally the highest probability trade. So, here we broke down through, it came back above. And again, this was the end of the day, so it's kind of hard to count that. I really don't like to. But an overnight trade, then you see it pull back to it, and you see how well it honored. I mean, the 20-period moving average, in my opinion, is a great trading tool, which is why so many things that I teach revolve around it. But yes, 20-period moving average, first pullback test, and then looking for my speed lines to go through the 20 period, both very important. Absolutely. Thanks for noting that. Todd?
Okay. Michael has 2 questions in a row, and I think, let's see, they're a little bit different. So he wants to know, how do you handle opening up or down gaps? He's read that 80% of the gaps are closed the same day. We'll start with that one.
Okay. Well, I guess I have to ask you, Michael, tell me, is he referring to stocks or is he referring to futures? Because as you guys know, from a futures perspective, I use 24-hour charts, so there's far less gaps. Can we just clarify that first? Or does he just care about the gap from the true close of 3:15 yesterday, regular trading hour, or 4:15 regular trading hours Eastern time, to 8:30 or 9:30 Eastern time, regular trading hours? Is that the gap he's concerned about?
He's referring to the SPX cash, actually.
Okay. Okay. And first of all, I can't say with statistical certainty that 80% of gaps fill overnight. I will say, though, that it does seem that far more of them fill than not. There are some of the market commentators out there that go ahead and actually have some of their primary strategies completely revolving around gap fills. Okay. So with that being said, uh, gaps do happen. I will say that usually on a daily basis, you said same day. I would say that usually within 3 to 5 days, uh, 80+% of those gaps fill. I don't know about same day. It does seem though that far more often than not, same day they fill as well. So I have to agree with you. If you're looking as a probability trader, 51.49 being your probability threshold, um, I would say realistically that I could just mentally recall gaps 60, 70+% of the time fill, perhaps same day, 80% of the time within 3 to 5 days. It's a higher probability strategy than many of the strategies that are out there, but I would prefer to use a gap fill strategy combined with like the 20 period. So let's say the SPX there, let's draw an example for you here, Mike. Let's say this is the SPX end of day bar, not this. I'm drawing a, you know what? I'm going to do this real quick. It's trying to find some white space on my bars here. There we go. White space. Okay. So this is the previous day's bar. And now all of a sudden we get the next day opening up down here. Okay. I would not want to go ahead. I know some of the market strategists out there go ahead and their thing is as soon as this thing opens that next morning, just buy it here because it's going to go ahead and rally back up to fill here. Okay. I personally don't subscribe to that theory. I don't do that. I think the probability of filling the gap is high, but at the same time, you could suffer heat as the market continues to open up and move down against you. You buy right there at the open, it moves down further against you, then comes up. But the question is, did you get yourself stopped out down here before that happened? What I'd prefer to do is see the market come in, bottom, and then all of a sudden, so here you got that 20-period moving average coming down night over night, and then all of a sudden, we cross that 20-period moving average, the speed lines come up above the 20 comes up. Now suddenly you're going in trading in the direction of the trend as you're trying to obtain that gap fill. It's a higher probability strategy. So what I would say is combine your gap fill strategy with some of my standard indicators that I've shown you already to increase your probabilities far more. Okay, Todd?
Okay, Michael's second question is: Do you look at a strong? Oh God, I kind of know the answer to this because I asked you this before. Do you look at a strong move as a wave 3 and expect later a wave 5, which I think he's referring to Elliott wave?
Okay, you asked me that question?
Well, I was asking your opinion on Elliott wave in general, and so he's
okay. So is the question?
I'm sure that's.
Is the question about Elliott wave then, or is it on?
I'm thinking because he's giving numbers to waves. Michael,
Yeah,
is that
so
true?
you got your first wave, second wave, third wave. Third wave being your best wave, and then 5 being your finality. And so, what is the question with that?
The question is, do you look at a strong move as a wave 3 and expect a wave 5 to follow down the road?
Well, I guess at a high level, the short answer is yes. Because let's forget about the wave theory for just a minute here. Let's go ahead and do it this way. Back to white space. All right. So the market's gone ahead and had a strong wave 3. Let's pretend this is a wave 3 here, okay? Then you got your pullback, your wave 4. Then you're supposed to have your final wave, your wave 5. Okay, if you've had, logic would imply, when you've had a good run, the market, just like the S&Ps in general, on a 1-minute chart, S&Ps go up, pull back, go up, pull back, go up. Okay, they kind of, they ebb and flow. Well, so at a macro level, it's the same concept. Throughout the day, the market goes up. If you have this, and see if you get what would be considered a wave 3 thrush, where you get several bars trending up, logic implies that you're likely to go ahead and get a pullback, okay, and that pullback could be to one of my support levels. It could be to a rising 20-period moving level or a moving average or so. But the logic implies you're going to get a support, pullback to a support, and then you're going to get one more thrust attempt. Now, how far thrust goes for stage number 5? Is, it could be a couple points, it could be several points. But yes, well, after you normally get a strong thrust in the market, you usually get a pullback, and then you get one more thrust, because that's the thrust that usually fakes everybody out. That's the one that everybody goes ahead and it goes back up, and they've already missed this whole move. They're frustrated as all get out, and they go ahead then and they see it coming up here, and they're like, I'm not missing any more of this. They buy into it. Then the wave ends, or the market stops moving. They buy the top, and the market moves around and rolls around and dies on them, and that's what usually causes the finality in wave 5. So to answer your question, Craig, yeah, after what would be considered a wave 3, I generally do look for a wave 5, but for various reasons, not just because of Elliott wave theory, not trying to give Elliott wave theory too much credibility in itself, trying to also interject the psychology behind it. So I just want to make sure I'm clear on that. Todd?
All right. The last question is from Wayne. And do you set any time limits for a trade? If I guess you're moving sideways for a while, or it's not moving in the direction you think you're moving.
Oh, Wayne, that's a great question. Listen, yeah, the short answer is absolutely. This goes back to the whole concept of if what you expect to have happen in the market doesn't, get out, and if you're not in a trade and go ahead and look to take an entry. Well, it's the same concept. When I get into a trade, I'm usually looking for fairly immediate response out of that trade. So I'm not taking a trade now expecting something to happen an hour from now. That's very important. I'm taking a trade expecting something's going to happen typically within the next 15 minutes to a little over 15 minutes. Usually by the time the next bar happens, I'm looking for something grand to have happened in my favor. And that's even if I buy early, because let me go and get the chart out here. Okay. So if I go ahead and I sell this, I start selling into this right here at the close of this bar because we're breaking my support level and it's 2 bars down. I'm expecting then this very next bar to go ahead and start working with me. Even if it's a pullback bar, I'm expecting to go ahead and have it pull back up to my levels and then fall from that level. So whatever bar I'm entering into, I'm not saying, well, 3, 4 bars from now, I think it's going to be down over here somewhere. I'm looking for that immediate action. So if all of a sudden we were to go ahead and, short this bar here, and then the next bar does absolutely nothing, does not in any way, shape, or form confirm that we are making progress in my favor, then I'm going to seriously look at, number one, am I going to scale into the trade more? Do I see an opportunity to scale in more? Or am I just going to scratch the trade because nothing's happening? I don't like sitting on dead money, because what you have to understand from a money management, from a risk management perspective, time is money is danger with these markets. Look at all the news that came out just in the last several days. $700 billion deal, no deal, maybe deal. From day to day, from hour to hour, it's up and down roller coasters. So I'm not buying into a position here hoping that it's going to do something here or here at some point in the future. I'm looking to get in, minimize my risk and time exposure to have something happen right away. If it doesn't, I sit there, and like I said, I have 2 options. Scale in more because I see that there's an opportunity at a support or resistance level that's now made itself even more pronounced to me. Or I say, you know what, the risk-reward ratio just isn't worth it to me here. I really felt it was going to go down this next bar. It didn't, so I'm going to go ahead and exit my trade. So To answer your question then, with that logic and understanding behind it, I'm usually not looking to sit there more than 15 minutes in a trade without something working my way. Todd?
All right. Well, that is it, Robert. And a couple of people have darted out. They had some obligations, but they were thanking you left and right for a wonderful webinar.
Oh, it's too bad you didn't get to say goodbye to him. But, I guess for everybody that's here, so, we spent about 4 hours and 15 minutes together today. I hope you found this really educational. I obviously tried to answer all your questions to exhaustion here. I wish you all the best this weekend. I'm looking forward to seeing each and every one of you that can participate in our chat room, both the public one, but also the student one, where we can discuss all these things even further. And I appreciate you guys taking the 4 hours and 15 minutes plus to be here with me today. And like I said, I try to give you as much high quality information as I could. So with that said, thank you. And I'm looking forward to seeing you Monday. And I hope you guys all have a great rest of your weekend.